All right, so I see we've got a good number of you have already been able to join us in the session, which is fantastic. I'm sure we'll have a few more coming along, but I think since we've got a packed agenda and lots to talk to you about today, we'll get going in the interest of time. So welcome again to those who've just joined to this full morning of training on the IFRS Sustainability Disclosure Standards. So pleased to have you here with us today on this truly collaborative training effort. It's been really driven by that demand from the market and from those who want to report against the standards to hear more about it. So we're very grateful to the Lesotho Institute of Accountants and the Maseru Securities Market for co-hosting this session with us today and bringing you all together. And we'd also like to thank the IFRS Foundation, the IFC and Bloomberg Philanthropies, who are also supporters of these sessions. And of course, thank you to you all for joining us as well. We so appreciate that you taking the time to do so. So I'll be going through a little bit more on housekeeping and the agenda shortly. But before I do, we have some opening remarks, firstly from the Maseru Exchange and then secondly from LIA. So to kick us off with that, I'd firstly like to introduce Motabang MP from the Maseru Securities Market. So thank you for joining us, and over to you for some opening remarks. Thank you.
Okay, thank you very much, Fiona. And thank you to the UNSSC for providing this training to us. Like you said, my name is Motabampi. I work for the Central Bank of Lesotho, leading the division, the domestic market operations divisions, under which the Maseru Securities Market is being managed. It is my pleasure to welcome you all to today's workshop on applying IFRS sustainability reporting standards, a topic that's both timely and essential as we navigate the evolving landscape of corporate transparency and responsibility. As role players and most probably as leaders in capital markets, we recognize the pivotal role that sustainability information now plays, not only for compliance, but for fostering trust, enhancing resilience, and driving long-term value. These standards provide a global framework that will help companies report ESG information consistently and reliably, aligning corporate reporting with expectations of investors, stakeholders, and regulators globally. In today's session, we will dive into the practical application of the IFRS sustainability standards. The goal is to equip all participants with deeper understanding of the principles, methodologies, and challenges of sustainability reporting under IFRS. I believe, Fiona, that in collaboration with Lesotho Institute of Accountants and UNSSE, we have a range of experts who will be presenting here today to guide everyone through the reporting process, clarify technical details, and share some insights from organizations that have already adopted or are in the process of adopting the standards. As a stock exchange, we are committed to supporting transparency, accountability, and sustainable growth by encouraging the adoption of robust reporting standards. We can foster a more sustainable, informed, and resilient marketplace. Thank you, everyone, for joining us, and we look forward to a productive and insightful session. Thank you very much.
Thank you very much, Motabang. That's really appreciated. Thank you for setting that context. Brilliant. So secondly, I'd also like to hand over to our second host for today's session. So I'll be introducing also Mokoseng Mafolo, who is chairperson of the Lesotho Institute of Accountants, Standards and Quality Assurance Committee. So thank you also for joining us, Mokoseng, and over to you as well. Thanks.
Thank you so much, Fiona. I think I'm audible from your side. Just like you said, my name is Maseru Securities, the chairman of the 47th Council Subcommittee for Lesotho Institute of Accountants, Professional Standards and Quality Assurance. Please allow me just to, in brief session, to define the Lesotho Institute of Accountants formation, that it was established under the Accountants Act of 1977, which gives the Institute the mandate of regulating the accountancy practice in Lesotho. Our mission as the LIA is to develop, enhance, and effectively regulate the accounting profession in our Kingdom of Lesotho through provision of internationally recognized education, training programs, as well as ensuring compliance. We are further in a short brief summary to say that LIA operates in a compulsory CPD program, which this one is part of it, for its members, which is aligned with the International Education Standards 7, which talks about the continuing professional standards as revised, and together with other standards of international education standards, which the members of the Lesotho Institute of Accountants today will reap in together. So please, here as the members of the Lesotho Institute of Accountants, I'm happy to say that today for this insight workshop of IFRS Sustainability Disclosure Standards, which is going to be delivered in collaboration with the Maseru Securities, in collaboration with experts from the IFRS Foundation, United Nations Sustainable Stock Exchange Initiative, and the World Bank Group's International Finance Corporation, who will reap and then will gain more paramount significance experience for the better of our country and for the benefit of our members. This event offers an essential dive into IFRS 1, general disclosures, and IFRS 2, climate-related disclosures, equipping everyone in here with the knowledge to navigate the increasingly critical landscape of the sustainable reporting. As the fellow Ndatim Tebang have just mentioned, and together I will just say in short that we will further learn to identify key sustainability issues and integrate them seamlessly into our decision-making process. Lastly, we will earn the CPD credits as the fellow members of the Institute and receive a certificate for this event. Please allow me, just by saying that, Fiona, without any much further time to say, let me thank everyone for having created their time to join for this workshop, which is going to be much of the benefit. Thank you so much.
Thank you so much for that, Mokoseng. I really appreciate it. And you covered some of my points there. So thank you for giving an overview for participants. That's brilliant. All righty, so we'll be moving on then just to give you a little bit of an overview of the format of the session, what the content will be and how it will work before we dive into the detail. So firstly, just a couple of housekeeping points. You will have probably noticed by now that you are all on mute in the session. However, that's not to say that we don't want your participation. So please do make sure to use the chat function to share with yourself and to share about yourself or any comments you might have. I see lots of you have already been doing so that's brilliant to see. We also have the Q&A box, which you can access on the bottom toolbar. So please make sure to share any questions in particular through the Q&A box, as that just makes sure that we can keep track of those and answer them there. Got lots of experts from the different organizations, as you've heard, on the line. So make sure to use the fact that they're here and get your questions answered as well. So as you're probably aware, we've got a live 3.5-hour session today. There is also a follow-on homework activity that you can optionally choose to do as well. As I've mentioned, we'll be using the live Q&A and chat function throughout. We will also be encouraging your participation in a number of exercises throughout the session. We'll be using polls within Zoom, and we'll also have a Menti, which we'll be sharing a link to you with closer to the next activity. So please do try to get involved in those activities if you can. It's always great to hear from you guys and to learn from that as well. So we really do encourage you to share in those activities. And finally, as Giseng very helpfully introduced already, you will be eligible to receive a certificate for taking part in this live session. To do so, you'll need to fill out a feedback survey, which we'll be sharing with you at the end of the session. So look out for that closer to the time as well. Brilliant. So I will just introduce a little run through of who's going to be delivering today's training. Firstly, you have myself, an SSE training officer with the UN Sustainable Stock Exchanges Initiative, and my colleague, Lois Guthrie, who is a senior specialist with our team. We then also have Robert Swiatowski joining us from the IFRS Foundation. He is a partnership manager for capacity building. And we're very grateful as well for the support ongoing throughout this programme of the IFC, particularly Relisa Germanova, who is the IFC's ESG officer, who leads on the Beyond the Balance Sheet disclosure programme. Great. So just to cover an understanding really of what we're looking to achieve in today's session. So we have 3 key learning objectives for you. Firstly, we're looking for you to come away with an understanding of the ISSB standards. Secondly, we'd like you to understand how to use the standards and put them into practice. And then finally, we'd be looking to identify what steps you can take to develop a disclosure plan applying the ISSB standards. So our exercises will be geared towards helping you get started on that disclosure plan, and the homework exercise that you can take away would help you to progress that further as well. So to support us in achieving those 3 objectives, we've broken down the structure of this session into a number of core modules, which you can see on the screen in front of you there. So firstly, we start with prepare, which is all around understanding the purpose of reporting, understanding the landscape of disclosure and how that's led to the global baseline of the ISSB standards. We then move into align, so thinking about how to set the direction for your own reporting, how you can really start to apply these standards and understand what additional disclosures you might need to make. Module 3 is all around implementing. So how do you set up the practices and systems that you need to really integrate this information into your processes? And then finally, we'll end on communicate. So thinking about the final format of your reporting, where it will be located and how to report efficiently and with confidence in your data. So just to show you how that breaks down in terms of an agenda, we'll be doing the 2 modules either side of a short break in the middle. We know it's quite a long session to concentrate, so a short breather just to refresh is always helpful. But as I've said, please do feel free to ask your questions throughout, and we'll be making sure to try and answer those for you as we move along throughout the session. We also just want to highlight as well that this selection of training materials that we'll be covering today is available to download from our website. I think we should have or be shortly sharing with you a link in the chat to the event webpage on our website where you can access those. So you'll be able to find the slide handout from today's session, which covers everything we've talked about and some hyperlinks and resources, the homework exercise, and after the session, the recording of it will be available from there as well. As I've already mentioned, there is a homework assignment you can download from that page, which helps with developing a draft disclosure plan. This isn't a mandatory requirement, but it's something that you can use to continue to support your learning and to start to think through what we've talked about today with your colleagues as well. And just to mention, this training isn't delivered in isolation. It sits alongside a suite of SSE resources that you can access from our website as well to support you. So we have some training tools in particular on transition plans, on climate-related metrics, and a gap analysis for your sustainability-related financial disclosures. So as Lois has just shared, I'd really recommend checking out this toolbox for further resources that can support you as well. Okay, well, that's all of an overview from my side, but now it would be great to hear from you all as well. So we'll be going into our first Menti exercise. So the way to access this will be to follow the link, which we'll be just sharing momentarily in the chat, which will take you directly to the Menti in question. You can see Lois has just shared that there. So follow that link to Menti, and then we can do the exercise together. So I'll just go into my screen share now, because that will also give you some extra access options if you'd like to navigate directly to Menti. So hopefully you can see that well. Yep. So you also have the option here of using that QR code that appears at the top of the screen. Or if you navigate to menti.com, you can enter that code, that 8-digit code that you see just at the top of the screen as well. So 3 different ways to access, but I'll just give you all a moment to find the link. But when you do so, feel free to type in some keywords from your side that just summarizes why you're joining us in the training today. And if you are having any issues accessing Menti, let us know and we can see if we can help, or otherwise feel free to share your thoughts in the chat as well, and we'll look at them that way. I'll just give you a second. Great, I see some responses coming through. So we have to explore, to learn, to understand, perhaps some exposure as well, which is, of course, interesting to get out of this, to learn more. Excellent. CPD for sure, learning, understanding. Learn more on the standards, development, relevance. We definitely hope to make it relevant if we can. Capacitate, yes, definitely. Lovely. Oh, I see lots of responses coming through now, so I'll just give it a second to settle. Great. Lots of great ideas though. So comprehension, exposure. Lovely. Thank you everyone for sharing those thoughts. That's great. So I'll move us in now just to our second question, if that's okay. Hopefully most of you had the opportunity to respond there. So our next question is just to get a sense from you all, if we think about those 3 learning areas that we were looking to get out of the session, just getting a sense of where you are now in those 3 areas. So the left-hand side of the scale is not comfortable at all, and the right-hand side of the scale is very comfortable. So if you just take a look and let us know where you think you're at about explaining the ISSB to your team, using the standards, and developing a sustainability reporting strategy. So give you a second just to let us know where you think you're at in terms of your current comfort in those areas. Hopefully we can help to improve that through the session. Okay. See the responses coming through. Alrighty. So most so far seem to be kind of down the lower middle end of the scale. A few people obviously a little bit more confident, which is great to see as well. If you have any experiences to share with everyone through the session, please do so in the chat as well. I'm sure that's really helpful. For the most part, it looks like we're all sort of closer to not comfortable than comfortable, which is of course fine. And that's exactly why we're here today, to hopefully help you shift along. So lovely. Thank you everyone for sharing that. So I will just switch back to sharing my slides with you now. Feel free to keep responding in the Menti as well. Alrighty. So yeah, that's great just to get a sense from you. And please do keep that Menti open as well. We'll be coming back to that with some more questions and exercises through the session, which is available at the link that you already have open there. So we'll be kicking off now with the kind of main training content. But before I do, I just wanted to give you a brief disclaimer, which is just relating to the examples that we're going to be talking about throughout the session. So we'll be using some extracts from particular organizations' sustainability reporting. And what we'd like to clarify here is that we're not necessarily saying that these examples are the right way to report or perhaps the best way. They're really just examples to help you consider what might work for your company. We recognize that your circumstances and context may differ from these organizations, so take from them what you find helpful, but as I said, no need to stick to them exactly in any sense. So our first module, as I've mentioned, is all around preparations, so building a solid foundation of knowledge. And that's where we're going to be starting today. So this is really looking at what we already know and what those standards that are in the marketplace and frameworks that have informed the ISSB standards that have come together. So the three segments of this topic will be kind of broken down into purpose. So what is the case for sustainability reporting and the business case from the market for it? We'll then move on to talk about the landscape. So how has reporting evolved, including how it's become simplified? And then finally, we'll land on the global baseline. So what are the core concepts and requirements in IFRS S1 and S2 that formed that global baseline? So to get started, we'll be focusing firstly on why and thinking about the purpose. So what we really want to think about here is what is the case for disclosure and what perhaps are the drivers behind it. So to help us with that, we'll be doing our first Zoom poll. So our question for you to begin with is all around your drivers for reporting. So hopefully that should be popping up for you now. But what we'd like to know, what are your reasons for disclosing sustainability related information? So you can tick as many of these as apply to you. So it could be regulatory requirements, sharing your management's objectives, perhaps peer pressure or comparison to your competitors, investor interest. Maybe you have other reasons and feel free to share those with us in the chat as well. Or maybe you're not disclosing anything yet and you're just getting started. So I'll just give you a second to respond to that poll. I see lots of answers coming through already, which is great. Great. I'll just see lots more tipping in, so I'll just give you all a second. I always like to try and get at least half of you participating, if not more. So please do vote if you haven't done so already. Okay. All right, I will close off the poll now. It looks like we're getting a few front runners and share those results with you. So it looks like we've got a bit of a split, but so just 45% have said that they're not disclosing yet. So you're getting started. So that's, of course, fine and what we're here to support you with today. But the next most common answer was regulatory requirements. So yeah, exactly. So maybe requirements that you have already, or maybe anticipating what regulation you might expect to see in the future as well. And then we have a smattering who kind of also indicated sharing your own objectives and investor interests were relevant for you as well. So that's great. Thanks for letting us know that. That's interesting to see. Just good for us to get a sense of. Okay, so I'll close that down and should be able to click out of the way and go back to the presentation now. So speaking about the sort of overall landscape of purpose and why organizations are coming to this, it's fair to say that investor interest in particular is often quite a key driver. And so one of the reasons for that is really the strength of support we now have from the investment community for integration of ESG factors. So here we see data from the UN PRI signatories, so Principles for Responsible Investment. And you'll see that we are now at this point up to over 5,000 signatories with $121 trillion in assets under management who've signed up to these principles. So a big growth in recent years. And so what's really driving that? What I think is interesting to highlight is actually a key driver behind this demand from investors is actually concern about the financial effects of sustainability information. And so this study here is from Morgan Stanley. And what they found is that the top driver for at least individual investors that was driving their interest in sustainability was actually financial performance. And so you can take a look at this study more closely, but I think it's important to clarify before we move on that actually, you know, this is very much relevant from a financial perspective, and that's what we're here to focus on. But also it's good, I think, to zone in on what we actually mean by financial performance first off. So let's take a look at that a little bit more closely. I know we have lots of accountants on the line, so I'm sure many of you are familiar here, but just bear with us to get this clarified. So what we're talking about here is financially material sustainability information. And so what we're going to be discussing in more depth in the workshop is what that word material means, but we wanted to be clear at outset about what sort of financial effects investors are looking to consider here. So starting with the effects on a company's performance, which you'll see in the profit and loss statement, and considering, you know, income or revenue and expenditure. So sustainability related risks and opportunities can have a financial effect by perhaps changing the revenue mix or total revenue of a company. If, for example, its demand from products and services might change due to ESG factors, or perhaps its production is disrupted due to extreme weather events. And then we can also see changes in expenditure. So, for example, increased operating costs due to higher energy prices, or a need to spend more on R&D to capitalize on sustainability opportunities. Or there may even be other costs as well required to meet regulatory requirements or to adapt to new practices driven by customer demand. So you'll also hear us talk today about effects on the company's financial position. So looking at what that means, we're often talking here about the balance sheets. So for example, a company may experience changes to certain assets or liabilities due to climate or sustainability issues. And we might see changes to portfolio value, or perhaps even write-offs of certain assets that are damaged or need to be repriced due to sustainability risks. And another financial effect that should be documented is changes to financing and the cost of capital. For example, perhaps increased insurance premiums due to climate change, or the possibility of new financial structures such as green bonds as well. And another key concept we wanted to flag here is the idea of sustainability-related risks and opportunities. So as you can see from this global risk perception survey from the World Economic Forum, risks evolve over time as well. So those risks that we might expect to face in 2 years' time may differ actually over a 10-year time frame. So those risks that are perhaps coming down the track in 10 years might not be front of mind today. And so what's important for disclosure is that we're preparing for those risks that may arrive in 5 to 10 years from now. And actually the investments that we might need to make today to manage those risks better may also lead to financial effects much earlier than when the risk itself would materialize. And another important aspect to clarify relating to risks and opportunities is how interconnected they are, of course. So this comes from the same report as I shared before and just shows how interconnected the different categories of risk are across the global risk survey. So whereas we might think of the different ISSB standards as separate topics, so one on climate and one on other issues, of course, we see a lot of interconnection actually between these topics. So when we're thinking about how to report on this and how to integrate it within our own organizations, we need to be thinking about that interconnection as much as we're able to. And so we'll be diving into that in a little bit more detail with reference to the S1 and S2 standards as well later in the session. Okay, so that's given us a little bit of an overview of the purpose of reporting and those sort of drivers that sit behind it. I'll now hand over to Lois, who will be talking about our next segment. Thanks, Lois.
Thanks, Fiona, and hello, everybody. So we've now briefly covered why sustainability reporting has been developed and why it's important because of the risks involved and the interest from investors, amongst other things. So now we're going to look at how the IFRS sustainability disclosure standards have been developed in the landscape of existing reporting standards. Before we do, though, we'd like to ask you a question from our Zoom poll number 2, which I think my colleague will launch. And this Zoom poll asks you, what frameworks are you currently using to disclose sustainability-related information? So you can choose as many of these answers as apply to you. Are you using CDP, Carbon Disclosure Project's questionnaires, the Global Reporting Initiative framework and standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, known as TCFD, or the UN Global Compact principles, or something else? And if it's something else, please feel free to tell us in the chat. Just give you a moment to fill that in. We've got a clear pattern emerging here, so I'm going to end the poll and share the results. And I can see that by far the most of you are using the integrated reporting framework, which we will be talking about later. And a few of you using the Carbon Disclosure Project questionnaires, the Global Reporting Initiative standards, and ISSB. Very few using the recommendations of the Task Force on Climate-Related Financial Disclosures or others. So thank you very much for completing that poll, which helps us understand your current practices. So today we're talking about the IFRS sustainability disclosure standards developed by the IFRS Foundation. I suspect many of you know this, but let's just understand what the IFRS Foundation is and how the International Sustainability Standards Board came to be. The IFRS Foundation is a not-for-profit, public interest organisation that was established to develop high-quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, you can see the 2 independent standard-setting boards that are hosted within the IFRS Foundation, and they are the International Accounting Standards Board that was formed in 2001, and their standards for financial accounting and reporting are in place in over 140 jurisdictions around the world. The International Sustainability Standards Board was formed in 2021 and released its first 2 standards in 2023, following strong demand for the IFRS Foundation to develop these standards. And the 2 standard setting boards, they work very closely together to ensure that their standards complement each other. Now, governance of these standard setting boards is provided by the IFRS Foundation trustees, who are in turn answerable to the monitoring board of public authorities. So how did the IFRS sustainability disclosure standards, how were they developed? Well, they were developed from using inspiration and taking the work of existing standard setters at the time. So the logos of the organizations that you see on the screen, all of the organizations represented have contributed to the evolution of sustainability reporting. There are lots of them, but they have a lot in common, although the range of objectives, guidelines, and the standards that they produced did cause confusion in the market that was sometimes called the alphabet soup of standards. Most of the organizations here, in fact, apart from the GRI, were focused on eliciting information from companies that meets the information needs of investors. GRI supports a broader range of stakeholders. Now, although this is quite a busy slide with lots of logos, the main message to take from it is that it is a picture of simplification and consolidation. Some of the work of the organizations represented by the logos has been consolidated into the IFRS Foundation. So CDSB, the Integrated Reporting Framework, and the standards of SASB have been consolidated into the IFRS sustainability work. The recommendations of the Task Force on Climate-Related Financial Disclosures have been adopted into the standards. CDP has aligned its questionnaire with what the climate standard produced by the IFRS Foundation. The work of the Transition Plan Task Force, insofar as it relates to disclosure, has also been taken over by the IFRS Foundation. And the IFRS Foundation and GRI are working very closely together to jointly identify and align common disclosures. So, simplification and harmonization is represented by this slide. And we're going to look at another Zoom poll now. I realise this may not apply to many of you, but it's a question that will make us think about the development of standards. This question asks, if companies all are disclosing using the recommendations of the Task Force on Climate-Related Financial Disclosures, do they automatically comply with the ISSB standards? We just saw that the TCFD's work has been absorbed into the IFRS Foundation, consolidated into. Give a moment for more people to participate in this. Right, I'm going to end the poll there and share the results. We do this training with many audiences, as you probably know, and the answer we see here is very typical across audiences. So it's kind of roughly split 50-50 true and false. The correct answer is false. So well done to many of you who answered false. But the reason for asking this question is to highlight that whatever your current practices are, including using the TCFD recommendations, you might have a lot of information you already need to comply with the ISSB standards, but you cannot assume that you automatically comply with the ISSB standards. It's important to read the standards themselves, but we'll be taking you through what they say today. So well done. Thank you everyone for answering there. So let's move on now, just to think a little bit more about that question. I won't go into this slide too much since not many of you are using TCFD, but if you are and if you're interested, the little picture we see on the left is a comparison that the IFRS Foundation has done between the ISSB S2 standard on climate disclosures and the TCFD recommendations. And it just shows you that the differences are mainly to do with wording, but also asking for more detailed or additional information than the TCFD did. So please do look at that if you are using TCFD. Otherwise, we'll move on now to look at the IFRS Foundation and ISSB's main objective. So their objective was to set a global baseline for sustainability information that forms a common language for sustainability disclosures and enables a comparable and consistent sustainability information to be delivered across global capital markets. So the Foundation is working with jurisdictions around the world and other stakeholders to achieve this global baseline. Now, the little symbols that you see on top of the blue box, they are meant to represent building blocks. And what this means is that regulators, stock exchanges, and others are able to add building blocks to the global baseline, where those building blocks are tailored to the needs of individual jurisdictions or particular stakeholders. So those additional disclosures can be required and added as long as the information is presented in a way that does not obscure the disclosures required by the ISSB standards. So what could these building blocks be? Well, they could involve disclosures that go beyond the remit of the ISSB standards, such as information covered by the GRI standards that are for a broad range of stakeholders, or jurisdiction-specific information that's relevant to investors or others. So this building block approach means that information doesn't have to be duplicated because we have this globally consistent baseline of standards, but it does allow for information to be reported in addition to the ISSB information. So with this global baseline, there has been a global backing for it. So the baseline is represented in the standards that the ISSB issued in 2023. The International Organization of Securities Commissions endorsed the ISSB standards and have asked their 130 members to consider how they can incorporate the ISSB standards into their regulatory frameworks. The Foundation is working with other stakeholders on the adoption of the ISSB standards and support in other ways. So, for example, they work with the International Auditing and Assurance Standards Board, who have approved a new assurance standard for sustainability information. As part of its regulatory implementation program, the Foundation is working with jurisdictions around the world who are planning or preparing to adopt the standards on a voluntary or mandatory basis. And of course, the Foundation is also supporting market participants who voluntarily opt to apply the standards. So that was our introduction to how the standards came to be developed. And Robert is now going to take us through a look at the standards themselves now. Over to you, Robert.
Yes, great. Thank you very much, Eloise, for this introduction. Indeed, we then move to the next section of this module. We talk about the business case and the market case for the sustainability reporting, the evolution of the landscape and how it's being simplified and rationalized. So now let's introduce IFRS 1 and IFRS 2 disclosure standards. Before we go into that, let's then go through some important key terms, which then we'll be using during this workshop quite a bit. And you can find the definitions in a handout, but I wanted to briefly mention them here. So first of all, we'll be saying the phrase sustainability-related financial information quite a lot. This can refer to the broad set of issues, including climate, nature or biodiversity, human or social matters, or others. Secondly, sustainability-related financial information is information about companies' sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. The other term about the sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. For example, it could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. All right, and now we're moving to the next part, and we'll talk about this four pillars, core content areas. And anyone familiar with TCFD will recognize the same terms here or content areas for the ISSB standards as well. And these are governance, strategy, risk management, and metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance and requirements on these requirements. We will discuss each of the 4 content areas today, and I encourage you to download the standards as a part of the homework assignment. All right, then let's talk about the IFRS S1. Let's introduce it and discuss what is this about. To all the preparers listening, let me start by saying that don't be afraid. Yes, there's a lot to understand, but you might be surprised that some of the details are already familiar to you. And for all the accountants listening, you too will be relieved to see many of the conceptual foundations developed by the IISB in the ISSB standards. So let's start with the IFRS S1, or to give it the full name, General Requirements for Disclosure of Sustainability-Related Financial Information. So IFRS S1 sets out general requirements for the content and presentation of the sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied throughout the standards. S1 asks preparers to refer and consider the applicability of the ISSB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information. The ISSB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. Finally, the standards can be used in conjunction with any accounting requirements. All right, so that's about the IFRS S1, and now we'll talk about IFRS S2. The scope of S1 is all sustainability topics except of the climate, which is covered by S2. The second standard, S2, focuses on climate disclosures, building on the same foundations of S1. For example, it fully incorporates the TCFD recommendations. It sets out the requirements for a company to disclose material information about its climate-related risks and opportunities, and requires that the disclosures of both cross-industry and industry-specific information. In terms of climate-related risks, this includes both physical and transition risks, which we'll come to back later. Other specific climate-related disclosures are required, for example, on scenario analysis and greenhouse gas emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. And now let's talk briefly about the relationship between IFRS S1 and S2 together. So S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because IFRS S1 sets out general requirements or parameters for the type of the information that needs to be provided in order to be decision useful for investors. IFRS S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. All right, and now we will talk through some conceptual foundations, which should not be new to anybody with the accounting background, but let's go through them. So these concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. To start with, companies must fairly present a complete set of sustainability-related risks and opportunities. Fair presentation also requires disclosures to be faithfully represented, and to achieve these, companies shall provide a complete, neutral, and accurate depiction of sustainability risks and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks and are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the 4 content areas, and the connections between the sustainability-related financial disclosures and the main financial statements. And to illustrate that, we have an example, and Lois will present this to you. Thank you.
Yes, thank you, Robert. And let's all remember the disclaimer that Fiona gave us earlier, that the examples we present to you today are really for inspiration. They are not intended to represent our best or even good practice. We're just using these examples to illustrate certain points to you. So the point we're illustrating with this example is about how a particular company has connected certain types of information. The company is BHP, which is a global mining company, and this example is from their annual report 2023. So what do we see being connected? Well, the first thing to notice is that the company is connecting its decarbonisation strategy with its investment process and decision making. So in the first paragraph, BHP says that all investment decisions consider the quantity of GHG emissions associated with the project, the cost per tonne of CO2 equivalent associated with the project, and the alignment with the group pathways to a net zero trajectory. So because the company has a pathway to a net zero trajectory, they're saying to us that when they make investment decisions, they are taking that pathway into consideration in their investment decisions. So they've connected investment decisions with the decarbonisation strategy. The second thing we see being connected is the decarbonisation strategy with various types of expenditure, now and in the future. So you can see how much was spent on operational GHG emissions in the reporting year. That's in the second paragraph there, and the amount was $122 million on initiatives associated with operational GHG emissions. But also in the third paragraph, we see how much the company anticipates spending until 2030, and that's $4 billion US dollars on operational decarbonisation. So again, connection between the decarbonisation strategy and expenditure now and the future. The third thing we see being connected here is the decarbonisation projects and net present value. So in the penultimate paragraph, the company tells us that based on their current assumptions, the achievement of medium-term targets is expected to deliver positive net present value for the group, as it has done with implemented projects already. So the last thing to notice about this little extract is the orange text at the bottom, which just gives us a connection to where readers can find more information on the range of investments the company's making to drive decarbonisation and sustainable growth. So I'll hand back now to Robert to take us through Zoom poll 4.
Yes. Thank you very much, Lois. Yeah, we'll have that. Let's go to the Zoom poll. We'll have the next Zoom poll, which you should be now seeing on your screens. And then just to check whether you had good understanding what we just discussed. So the question is, what information should be considered for connected information? And we have 3 possible answers. And A, governance strategy, risk management, and metrics and targets. B, sustainability-related financial disclosure and financial statements. C, sustainability-related risks and opportunities. And so what is then being understood as a connected information in the meaning of IFRS? And I see the answers coming in. That's looking Good indeed. All right, I think we have now enough. So I'll end the poll and show you the results. So many of you had, all the answers are correct. So all these elements are should be considered connected information, and all are interrelated, and in IFRS understanding of the standards, this constitutes a connected information which should be presented as such in your sustainability disclosures. So thank you very much for this. We'll move to the next section and we'll discuss the materiality. So finally, the standards are built on the concept of materiality as defined by the IFRS Foundation. And we are going to go into this in the more detail later. But just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured, could reasonably be expected to affect investor decision making. So this definition of materiality is something which you also should be familiar of the accountants, because it's based on the ISSB definition of materiality, and this one is very similar. And there is a lot of additional guidance which should help you to apply sustainability disclosures. So during the ISSB consultation and the exposure drafts, one of the key feedback topics was that the importance of supporting preparers, particularly those with more limited resources and those in emerging economies. So in addition to the standards and application guidance published in 2023, a number of educational resources were also published. Since then, others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The ISSB standards were aligned with the IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated with more plans to come. I should also note that IFRS Foundation Capacity Building Program, launched at COP27, is a key part of our support to preparers, and SSE training initiatives is one of the most important deliverables. Right, so please seek out those additional information and guidance, because that might be very helpful. We'll have then the next poll number 5. And it should be launched right now. So the question is about water, and the water, it's a vital input to your business in this example, but the ISSB standards do not currently have a specific standard on water. What should you do? And we have multiple answers. Do not disclose anything about the water. B, consult the sources of guidance listed by ISSB. C, encourage a consultancy to help. D, copy your competitors' reporting. So we have answers coming in. There's one answer which is clearly preferred. All right, I will then end the poll right now, show you the results. Indeed, the B, the answer is the correct one. Consult the sources of the guidance listed by ISSB. Although C and D are also could also be helpful. It's perfectly fine to engage a consultancy to advise you on how to disclose this matter, and then also benchmarking your report on your peers, and using the best practices being used on the market might be helpful as well. So C and D could be also considered here as an option how to address this issue. All right, thank you very much for this. And now I will hand out to Fiona to summarize this section.
Thanks very much, Robert. That's brilliant. So as Robert mentioned, we're now at the ends of our first module. So before we move back to a Menti exercise, which I just reshared the link to in the chat, so feel free to navigate to Menti in the background so you're ready. But before we do that, I just wanted to summarize some of the key things we covered. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway we're really hoping that you leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. And ultimately, if you're not aiming to make good use of that data that you're collecting to really improve your own strategic decision-making, you're wasting effort here. So it's definitely good to embrace the benefits of preparing this reporting to support you internally as well. Particularly as well, if you have operations in high impact or hard to abate sectors, your competitors may disclose risks and opportunities that they've identified and are managing. And that would then leave your investors wondering why perhaps you're not addressing the same issues if you're not reporting on them. And ultimately, in the long term, that could start to impact your ability to raise funds as well. So we then moved on to look at the evolution of sustainability disclosure standards and the formation of the ISSB with that aim to simplify the landscape, as Lois talked about. And when you're thinking about voluntary disclosure, you shouldn't see these standards as competing with the ISSB standards, but rather building on top of them with those building blocks. And finally, we introduced the standards and important concepts that you'll need to understand in order to use the standards correctly. And a key point that we want to reiterate here is that these standards and guidance come with designs meeting the needs of investors. And so they're really heavily focused on those prospects that we talked about earlier in the session, relating to financial effects and position and to risks and opportunities. Okay, so with that, we'll move into the Menti exercise. So just to summarize the activity we'll be getting you to do in Menti, we're really looking to think here and reflect on what we've heard so far and think about what will the skills and capacity be that you need in your organization. So how do you identify those gaps? So some of the areas that you'll need to think about might be the tone from the top. So how do you identify who in your organization's leadership is going to be responsible for these issues? How are you thinking about integrating these topics into your existing teams and existing functions and processes? And perhaps maybe there's a need to negotiate. So will you need to work with your colleagues to build consensus on the case to take this on board and agree monitoring and maintenance approaches, for example? So yes, that's the question that we have for you in Menti. So the link should be in the chat if you don't have it open already. And I'll just share the screen again from Menti. I see a few of you have already been putting your responses in the background, so that's great to see. As a reminder, the code is at the top of the screen if that's an easier way for accessing it. And I'll just share that QR code there that you can use as well. So we'll just give you a second to have a think about that, and then we'll start to reflect on some of the responses that we've seen come through. So give you a moment just to put your thoughts in, however formed they are. Just great to know where you're at currently with your thinking. So just share whatever comes to mind to you really around going about identifying these skills and knowledge gaps. Okay, so the responses we've had so far, just to give you a flavour, so we've had surveying internal teams, so for example, finance, sustainability, legal and operations about their understanding of ISSB, conducting interviews or workshops with heads of department. Yeah, that sounds like a really comprehensive approach and great to bring all of those different functions together. Holding a meeting with finance and accounting to identify skills gaps and systems that we can implement to help report on sustainability. Absolutely. I think, I know we have many accountants with us today, and, I think that skill set that you already have and the experience in applying the IASB standards will translate really well to this topic. I will just remove the QR code now so we can see. Having a meeting with the team to try and identify gaps. Yep. So surveying internal teams, conducting interviews. Yep. A need to continuously attend training for sure. So continue to upskill yourself and your colleagues. So I think as much as you can share back what you learned from today's session with your colleagues is fantastic. And also if they belong to other bodies and professions, maybe they can find out more from their perspective too. A skills audit, communicating with staff about gaps, exactly, making sure everyone is clear on what needs to be achieved. Perhaps interviews as well, as we've said. Preparing a Q&A to test the employees' skills and knowledge. Yeah, that's a good idea. I think sometimes we think we might know enough about a topic, and then when we're actually asked some tricky questions, we might realize there's more to learn. So I think that might be a helpful way to understand where existing knowledge is at already. Thanks for all of these great ideas. This is brilliant. Thorough engagement with members of staff already involved in reporting. Open platform for those who already have knowledge and skills to come through and help. Yes, I think that's a brilliant approach. So making sure that you are providing the opportunity for staff who might be particularly interested to support this, to get involved and leveraging the skills that they already have. Particularly perhaps those who come from outside the organisation, they may have already experienced something similar elsewhere and could help you. Creating a targeted training and development programme, including online courses. Yeah, there's lots of resources as well that we'll share with you at the end that you could probably use to support you there. Some of them we've mentioned already. Excellent. I see more and more ideas coming through. This is lovely. It's great to get your engagement here. Creating a learning culture. Yes, exactly. So making sure that everyone is of a mindset that they can continue to learn more about this. Consult ISSB specialists for guidance on common industry gaps. Yes, that's a very good idea. So yeah, getting a benchmark of what organizations in your industry might typically report upon, or what sort of risks and opportunities they may face, can be a very good starting point to benchmark where your organization is at against what others are doing. See competency from a HR perspective. Yeah, I think getting the support of your HR colleagues to think about how you can get the right resourcing, right capabilities and learning development opportunities together. Lovely. Well, lots of really great ideas there. I think we will leave that there, but I really appreciate how much has been shared through that. So that's great to get all of your thoughts, and hopefully that will give you something to build upon as well when you move into filling out your own disclosure plans. Okay, so we'll go back into the presentation now after that, and I'll hand back over to Robert, who'll be going through our next segment. Yes,
great. Thank you, Fiona. Indeed, we're moving to the next module of this workshop. So it's about alignment. And now that we have introduced the initial concept, let's dive into how to apply the ISSB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well peer practices and your leadership objectives. And in order to understand how to ensure your disclosure meet global standards, we'll look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve the global baseline for disclosures. And once we cover that, we will also discuss how additional disclosures fit. To begin with, let's focus first on how to apply ISSB standards as the global baseline. Let's then get started on the first core content, governance. This includes aspects that relate to the governance structure in the organization and how the management is applied. All right. For each of the content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements. And for example, as a part of gap analysis. So let's look at the governance and the management requirements. We can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities. For example, how, is the management responsibility delegated to a specific role of committee? How and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. Whether progress against these targets links to the executive remuneration. For more information, you can make use of the SSE checklist tool, but remember, it is not a replacement for reading and using the full ISSB standards. And now let's take a look at a couple of examples of these to see what it means in practice. And I'll hand over to Lois.
Thank you, Robert. The first example we're going to look at is from AIB, which is a high street bank in Ireland that have many sustainability credentials. So as you all know, particularly those of you that are using the integrated reporting framework, there are multiple governance models to choose from, and it's important that your organization uses a governance structure that's fit for the purpose of your company and the needs of your company. So this is just one example from an Irish bank. And what we can see is that there are three board committees here: the Board Risk Committee, the Sustainable Business Advisory Committee, and the Board Audit Committee. Each of these board committees is in turn supported by an executive subcommittee on risk, sustainability, and disclosure. So there's a clear demarcation between the three types of functions: audit, risk, and sustainability, including a split between financial and non-financial disclosures, and management supports the executive committee and feeds into them too, as does group internal audit. So you'll see lots of different ways of approaching governance. This is just one of them. Let's have another look at a different disclosure about governance. And this is from the car manufacturer, Japanese car manufacturer, Toyota. And what we see here is an extract from their disclosures about governance to the TCFD recommendations. There are three things to point out here. First of all, we can see what the role of the board is. So they deliberate and supervise strategies, major action plans and business plans, and they monitor progress towards targets addressing climate issues. Of course, they'll have lots of other roles in relation to other parts of the business, and this just sets out the role in relation to climate change. The second thing to point out here in the penultimate bullet point is what the board has done to inform long-term strategy on climate change. So one of the things that they say they did was to set up the Toyota Environmental Challenge 2050 and formulate and review medium to long-term targets and action plans. The third thing we see in the last bullet point is information about the actions that the board has taken. So they tell us what decisions have been made at the board of directors meeting. This was back in 2022. So they reported on and approved the identification of carbon neutrality as a key matter in relation to climate change and the development of a plan to transition to carbon neutrality by 2050. And they also made a resolution on the level of battery-related investment they should make for cars that operate on as battery electric vehicles. So three things there from this example about the role of the board, what they do to inform a strategy, and the actions that they've taken. So I'm now going to hand over to Fiona, who's going to take us through the core content module on strategy.
Thanks, Lois. Great. So with those examples, hopefully supporting you to see what governance looks like in practice, we're going to look at the next area of strategy. So there are more disclosure requirements in strategy than governance, but it's really where you can see the benefits from sustainability related opportunities as well and prepare through better risk management. So as you can see here, there are 3 high-level areas that we focus on within the strategy content area. That's risks and opportunities, the effects of those risks and opportunities on finances and strategy, and then finally, resilience. So we'll take a moment to go through each of these in turn. But before we do, IFRS S1 and S2 requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability risks and opportunities. So if we look at the first requirements related to risks and opportunities, there's some questions that you probably like to ask yourselves internally. So thinking about disclosing information on risks requires you to include the description of the effects, the time horizons over which those effects are expected, and that should also keep in mind that the financial effects of a risk might occur either before or after it materializes and might also change over time. And the last 2 questions on this list in particular focus on climate, aligning to the requirements of the S2 standard. So for example, investors will want to understand what types of risks and opportunities an organization may see. And this typically uses the categories of risk identified by the TCFD, which are physical and transition risk, which we'll talk a little bit more about later. So both of these standards include guidance to support companies to identify and disclose risks and opportunities. For example, they recommend using industry-based guidance for particular sectors and also referring to the ISSB standards as well. So again, let's have a look at a few examples here to see what this might look like in practice. This example comes from Gold Fields in their integrated annual report. Gold Fields is a gold producer with mines in various countries. And in this extract, we can see which risks the company has identified, how they've identified them using a prioritization matrix, and also how those risks align with the strategic priorities that they have and what the mitigation policies are that they have in place to manage them. So there's a lot of information in their report that follows on from these. So I'd recommend looking at the link in the slide handout as well. But here you can see how they're sort of color coding the particular types of risks they expect to see and thinking about the connectivity of those issues as well across their strategy. And so another example of risks and opportunities, another aspect of risks and opportunities rather that's important to consider is around the financial effects and particularly thinking about what those might look like over different time horizons. So we need to be clear here what time horizons we're referring to. And with the case of sustainability disclosures, this can be a little different to traditional financial reporting. So the S1 and S2 standards ask you to identify what time horizons you're using and within what of those time horizons any material effects may be expected to occur. So for example, if you expect an effect to be over the short, medium or long term. And so what the right time horizons are can vary between different types of organization. So for example, you'll need to consider your business planning and investment cycles, strategic planning, the lifespan of any assets that you might have, or even other factors as well. So it's important to remember that you need to define those time horizons. So don't expect your investors to necessarily know what you mean by short and medium, unless you've provided a quantitative definition to them. And so moving on to the second group of disclosures in the strategy category. The first section of the strategy component related to risks and opportunities. And here we're thinking about the effect of these risks and opportunities and where it occurs in the business. So to start tackling the disclosure requirements of this standard, Companies might want to start asking themselves questions such as describing those effects, understanding the response plans that they have for mitigating or adapting to the effects, or indeed on capitalizing on opportunities as well. And again, let's look at a few examples of this here. So we have one example here from BASF. So BASF is a global chemical producer, and this disclosure comes from their annual report. And so here the company acknowledges that their strategy is affected by changing climate, scarcity of natural resources, pressure on ecosystems, and a growing population. And so here they've been able to show which risks and opportunities in particular they're expecting will affect their company. And so they then go on to explain these effects. They say that their business in the chemical sector has a key role to play in addressing the challenges identified. And that can include innovation, the use of raw materials more efficiently, perhaps reducing waste and enabling healthier food production as well. So as well as the changes they hope that chemicals will offer society and the economy, the company itself is also going to need to undergo changes to adapt to these trends. And these transformations are going to need to occur along the value chain. So as they show in the excerpt here, we can see where in the company's supply chain, products and production elements, the different aspects will occur as well. So sometimes one of the obstacles we know companies face when reporting on these effects, however, is what detail they should be disclosing. And so in that example that we looked at just there from BASF, they were showing us mostly qualitative disclosures and descriptions. But what about quantitative information? So a company is required under the standards to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability risks and opportunities. However, the standards do set out criteria for when only qualitative information is required. So companies can use qualitative information if they cannot separate the effects of a climate risk or opportunity from other types of effect, or if there is a high level of measurement uncertainty. And also if the company doesn't have the skills, capabilities, or resources to provide that quantitative information, then qualitative information is also accepted in that case. So now we're coming to the last part of the strategy component. The first part was looking at risks and opportunities and how they're going to affect the organization. The second part considered what those effects will be. And now this final group is preparing for uncertainties and thinking about resilience to those risks and opportunities. And this really gets into the practices and processes that a company must have in place to assess its resilience and make strategic adjustments. So disclosures here should be focused on scenario analysis and how it's been used. And so scenario analysis is a concept that some organizations would be familiar with from the TCFD recommendations. But if it's new to your organization, we will be going through a little bit more detail on it as well. So some of the questions that you can consider asking internally on this when you're starting to disclose are really thinking about what your company's capacity is to adjust and react to those uncertainties, and how might different scenarios play out that enable you to test your resilience to these concerns. So we have a few examples to show you here of how some companies are approaching this. So starting with Stora Enso, which is a Scandinavian forest products company, they have a diagram within their report, which you can see on the right-hand side here, that shows you what they are projecting their sales may look like in 2030. And this is where they distinguish between their existing business activities and their growth businesses, which is really around how they see sustainability becoming a real key growth area for them. So they don't provide any quantitative numbers here on those financial values, but we do have an immediate picture of actually how much opportunity they expect to have from the sustainable transition. And actually they're trying to set out a long-term vision to transition their business. So they talk about repositioning themselves from being largely a pulp and paper company to becoming a renewable materials company to ensure their long-term future. So this gives us a sense really of how they're planning to both expand through a focus on sustainability and to sort of strategically position themselves in a way that would make them resilient to these changes that they're going to need to make. And our second example here is Solvay, which is a Belgian chemicals company. And here we're looking in particular at how Solvay disclose the financial effects on their strategy. So in particular, we want to highlight that they're being transparent about the estimates, and they note that they have been developing their scenario analysis tools. So if you're using scenario analysis as a tool, investors need to understand how you're using it. And you can see in this excerpt that they note what assumptions they've been using in their scenario analysis. They indicate that they've worked with a consulting firm to conduct the analysis, and they also highlight some of the internal experts that they've brought together to support them in this assessment. So we won't go into all of the detail on their disclosure, but if you look in their annual report, I'd recommend looking at how they approach reporting and then analysing each of their different business areas. And in the example on the bottom of the screen here, they particularly pull out the conclusions of their scenario analysis relating to their soda ash business. So soda ash is an ingredient that goes into windows, rechargeable batteries, and detergents, among other things. And so the problem here is that soda ash is very carbon intensive to produce. And Solvay kind of acknowledge here that they need to really work on coming up with more sustainable ways to produce soda ash. And they think about the impact that rising energy and commodity prices is likely to have on the costs of producing this, and also how the demand for the product might increase as well in the future if more sustainable building practices are adopted, which rely on more glass as an input. So they conclude ultimately that they expect to be resilient to some of the changes and trends in this sector, but it shows us really how they're thinking about that now and how they're, again, managing their resilience of that particular business activity. Great, so hopefully those examples have been helpful. But just to test again what your understanding is of this section, we have a little question just to go back to one of the points we discussed on earlier relating to qualitative and quantitative disclosures. So the question to test is, can a company choose to disclose only qualitative information and or combined quantitative information about their financial effects when any of the following apply? And so again, you can select more than one here if you think more than one is right, but qualitative disclosures are allowed when either the company can't separate the effects of a climate risk or opportunity from other effects, when there is a high level of management uncertainty or measurement uncertainty, my apologies, or finally, when quantitative information sheds a negative light on the company. So take a second just to let us know which of those you think are valid reasons for disclosing qualitative information. See, we have a few responses in, but a few of you still to vote, so I'll just give you a second to read those words through and let us know what you think. Okay, I'll just give a moment. We've still got about a third of you responded so far. It'd be great to get a few more answers in, so I'll just give you a second. Okay, we're up to about 100 respondees, so I'll close that now and share the results with you. So yes, most of you were absolutely right here. So the top two are indeed valid reasons why qualitative disclosures, or a mix of quantitative and qualitative disclosures, may be allowed under the standards. And the final answer is indeed not correct. So it's important, as we talked about earlier in the principles of reporting, that information is balanced and transparent. So it is important to still provide information where you're able to do so if the answer is negative and there's a risk. So yeah, that's absolutely right. Lovely. So I'll stop sharing with you there on that front, and then we will be handing back to Lois to talk about some of the climate considerations.
Thank you, Fiona. So when we looked at the governance requirements, they're very similar across S1 and S2. There are no specific additional requirements for climate. The requirements apply to sustainability and climate equally. However, when disclosing information related to strategy, there are some additional requirements that specifically relate to climate. So we're going to have a quick look at some of those. Now here we see the title is from TCFD to ISSB, but given that very few of you have used the TCFD, I'm just going to go through this slide quickly, really, and use it to explain what S2 says are the climate-specific strategy requirements. So IFRS S2 says, in terms of strategy, when a company is making disclosures, it should refer to and consider the applicability of the industry-based disclosure topics. Now, those industry-based disclosure topics are set out by the IFRS Foundation. They're based on the ISSB standards and they're available on the IFRS website. The standard asks for detailed information on where in the business model and value chain risks and opportunities are concentrated. So is there a part of the business model or the value chain where the risks and opportunities are? There's more vulnerability to those risks, for example. The IFRS S2 says that companies should give information about the effects of climate-related risks and opportunities on their business model, their value chain, and their strategy, most importantly. So we saw some examples about that earlier, that the strategy might be affected by climate because the company, like Toyota, for example, wants to develop products that are more sustainable. The S2 says that the company should S2 actually sets out criteria for when a company should use quantitative and qualitative information for the disclosure of current and anticipated financial effects. So the disclosure of current and anticipated financial effects is a new area of reporting and many find it challenging. But within S2, you will find rules on when you can just use qualitative information to make your disclosures. The standard also says that the company should just use all reasonable and supportable information to it that's available at the reporting date without undue cost and effort, and can use an approach that's commensurate with the company's circumstances for specific requirements. We're going to be looking at this in a bit more detail later, but really what this is saying is that the standard setter recognizes that some of this information can be quite complicated to find or to report, and therefore the company is just required to use reasonable and supportable information commensurate with its own circumstances. Now, we've heard that the strategy disclosure requirements say that a company should test the resilience of its strategy using climate-related scenarios in the case of S2. But the standard does not specify which particular scenarios the company should use. This is up to the company to decide. And there's a further information required from companies in S2 about the resilience of their strategy, including things like what period the company has assessed its resilience over. So we're going to move on now to look at another particular aspect of S2 that's different to S1 in relation to strategy. So the S2 standard says that if a company has a climate transition plan, it should disclose information about it. The standard defines a transition plan as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy. And this might include greenhouse gas emission reductions plans. So as I said, there's no requirement to have a transition plan, but if you do, then the standard says you should disclose information about it. Now, the transition plan, because it's an aspect of the company's overall strategy, should be aligned with that strategy, business case, and business motivation, so that the decarbonisation levers used for the transition plan are those that are most economically and technologically feasible for the company and that are aligned with the overall strategy. The transition plan might also be aligned externally with the goals of science, including and other statements, for example, net zero pledges made by the jurisdiction, climate neutrality goals at national and international level, for example, through Paris-aligned commitments. The transition plan should set long-term goals with clear mitigation and adaptation activities and include interim targets and milestones that are monitored perhaps through governance or management processes. The plan should be transparent about the dependencies for its success. We all know that the climate transition has a lot of uncertainties associated with it, so there should be transparency about what the plan is dependent upon, what are the risks and challenges of executing it, and how will the company deal with residual or unabated greenhouse gas emissions. We know that the transition will proceed in different ways for different sectors, and therefore it's really useful to look at sector-specific pathways to inform the development of the company's transition plan. And we're going to look at some resources that show sector-specific pathways in a moment. And there are organisations, including CDP and others, the Pathways organisation, that have set out the hallmarks of the credibility of a transition plan. So it's useful to look at those too. So now we're going to look at some of the resources that can help you understand what are the hallmarks of transparency, what are the sector pathways. So in the middle of this slide, and we can only show you a few of the resources, of course, there are many more than this, but in the middle of the slide, you can see the resources that have been prepared by the Glasgow Financial Alliance for Net Zero, known as GFANZ, and they set out the expectations that companies and financial institutions can use to develop their transition pathways, but as you see, they also have sectoral pathways, in particular for financial institutions. On the right of the slide, you see the disclosure framework of the Transition Plan Task Force. Now, the TPT produces a lot of other guidance alongside this disclosure framework that can help you design your transition plan. On the left-hand side of the screen, we see a little triangle, and what this shows is that each of these organisations is designed to support each other. So the IFRS standards at the bottom set the requirement to make disclosures about a transition plan, but the work of GFANZ and the Transition Pathway Task Force help build on those requirements by offering resources and guidance as to how you can do that. Of course, as we shared in the link earlier, you can also find the Sustainable Stock Exchange training tool on transition plans, if that would help you. Now, you'll be glad to hear that the next thing we're going to do is to take a quick break. So it will just be for 5 minutes. We'll play you some music during the break, and you'll see the timer counting down the 5 minutes so you know when to return. So have a nice stretch, a drink, and we'll see you back after the break, and feel free to submit any questions during the break as well in the Q&A box. See you in 5 minutes. Welcome back, everyone. Hope you had a good little break. It goes fast. So we've been through the core content area on governance, where the rules across S1 and S2 are quite similar. We've been through the strategy core content area. It's actually the longest content area in the standards. Now we're moving on to risk management. So as you can see from this high-level description, this category of disclosures requires preparers to provide information on their process for risk management of sustainability-related risks and opportunities, as well as how those processes fit into their overall risk profile. So the sorts of questions that you might want to evaluate as you think about how to respond to these requirements on risk management are: what processes and policies are being used in your company to identify, assess, prioritize, and monitor sustainability-related risks and opportunities? And how is sustainability risk and opportunity management integrated into the company's overall risk management process? So you may well already have this process. And the sorts of things that perhaps to start thinking about and asking questions about internally are: what are the inputs and parameters used for risk management? Are they suitable for sustainability-related risks? How are the risks and opportunities prioritized? What criteria are used to assess them? Is it nature, likelihood, magnitude, probability? How are the risks and opportunities monitored? And have processes changed since the last reporting period? So unlike the other content areas, this is really about process. Let's look at the climate-specific considerations relating to risk management. Now, again, here we say that this is from TCFD to ISSB, but actually this part of the learning can just be regarded as a summary of the types of things that IFRS S2 says about risk management. So the S2 asks for companies to provide detailed information about the input parameters they use to identify risks, whether and how they use climate-related scenario analysis to inform risk identification, and whether risk management processes have changed since the last reporting period. And the same principles apply to the identification, assessment, prioritization, and monitoring of opportunities. The other thing to note about IFRS S2 is when it comes to climate-related risks, we actually have a definition of what is meant by climate-related risks. So part of identifying the risk is to understand what it is and how it's defined. And here we see that the definition of climate-related risks comes in two categories. There are transition risks that arise from efforts to transition to a lower carbon economy, and they are categorized as policy and legal, technological, market, and reputational risks. We can see some examples of these types of risks in the middle of the slide. So increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, and so on. The physical risks from climate change can be event-driven. They are acute risks arising from weather-related events such as storms, floods, droughts, or heat waves, which we know are increasing in severity and frequency. Chronic risks are longer-term shifts in climatic patterns, including changes in rainfall, temperature, sea level rise, changes in water availability and quality, biodiversity loss, and changes in soil productivity. We see some examples in the middle of the slide again relating to more extreme weather events, perhaps that can affect the cost of raw materials. The thing to note here is, from the ISSB's point of view, the standards note that all of these types of risks can have financial effects on cash flows, access to finance, cost of capital, and those effects can manifest over different time horizons, the short, medium, and long term. And this is what the companies are asked to provide information about. The same applies to opportunities. We have a definition of the types of climate-related opportunities to which the standard applies. And these are opportunities that can come from your efforts to mitigate and adapt to climate change, such as opportunities for greater resource efficiency, innovation in your processes, using different energy or lower emission energy sources, developing products and services for consumers that are interested in more sustainable products, developing opportunities in new markets, and increasing the resilience of your company's strategy. So we can see these types of examples listed in the middle of the slide. And again, these opportunities can have financial effects on your cash flows, access to finance, cost of capital, and these effects can take place over different time horizons. And we've seen some examples of these types of opportunities, I think, from Stora Enso earlier, where they showed the extent to which their projected income is attributable to the new sustainable products that they're developing. So we're just going to look at one example about climate-related risks and opportunities, and this is from NATS, which is the UK's air navigation service provider. It handles UK domestic and North American air traffic control. So many of us know that the physical risks we've just talked about, bad weather, it really causes delays for airlines, airports, and passengers. And this can lead to increased carbon emissions due to aircraft having to circle or being held or being diverted when airspace becomes congested or inefficient. So what the company is doing here is showing how these weather events in 2019, the predicted weather events in 2050 is affecting the company. So you can see in the first panel there, bad weather forced airlines to fly an extra kilometers, burning extra fuel and producing extra CO2. So they're telling us in the case of their specific company what the particular effects of weather was. They tell us that they're planning to reduce flight durations. So the opportunity there in the last panel is that there could be opportunities to save tons of fuel and tons of CO2 and to build physical and operational resilience into the strategy and the long-term investment plans. So we've covered the risk management section now, so I'll hand back to Robert to take us through the next core content area.
Yes, thank you, Louise. Indeed, we're now moving to the final core content area of the standards, metrics and targets. Let's start with metrics. Requirements on metrics are designed to enable investors to understand a company's performance in relation to its sustainability-related risks and opportunities. And the preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as methodology. For example, what is the method of calculation? What were the inputs? Are there limitations? And what assumptions are involved? These are the considerations should be taken into account when we are defining the metrics or choosing the metrics. Regarding the targets, so requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. And disclosures include whether they are qualitative and quantitative, and whether they are set voluntarily or by law or regulation. The metric to set the target and to monitor the progress towards its achievement, and the baseline period from which the progress is measured and the period to which the target applies. Additionally, the standards also require the information, what are the milestones and interim targets, and if there have been any revisions to the target with an explanation about the revisions. And to illustrate that, we have an example. Again, back to Lois.
Thank you, Robert. This example is from a company called ArcelorMittal, which is a multinational steel manufacturing and mining corporation. And this little extract is about how the company reports on some of their metrics and targets. So the first thing to note is that the company has an ambition to have a leadership position within the steel industry and to achieve net zero steelmaking globally by 2050. So that ambition tells us that there will probably be metrics and targets associated with that ambition. And indeed, they tell us in the second paragraph that the company's target is to reduce carbon emissions intensity by 25% globally and 35% in Europe in 2030. So interesting to note here that a target can be different for different regions, and that there's a timescale attached to the target. They then tell us the scope of the target. So the targets both cover scopes 1 and 2 greenhouse gas emissions for steel and mining per crude ton of steel. At the end of the first paragraph, they also tell us the anticipated gross investment associated with these targets of $10 billion. And elsewhere in this extract, I won't go into it in detail, what they're telling us is about their dependencies for success. So what do they need to achieve their ambition? Things like policy making and a supportive regulatory framework. The other thing they tell us in this extract is about the assumptions behind their plan to deliver this ambition. And there's more information about this and other examples available in your handout, which you can download. And Robert's going to take us through the next part now of metrics and targets.
Yes, thank you, Liz. All right, let's now then talk about some of the climate-specific considerations for disclosures on metrics and targets. The TCFD framework included recommended disclosures, which IFRS S2 builds on and adds to as a part of required disclosures. And for example, IFRS S2 requires disclosures of industry-based metrics relevant to companies' business model and activities. Additional disclosures are required on greenhouse gas emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about the company's financed emissions. In addition, IFRS S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 greenhouse gas emissions disclosures. While IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions disclosures by the constituent gases, IFRS S1 includes requirements on disaggregation that would result in the disclosure of these gases being required if such disaggregation provides material information. And here I'd like to remind everyone that you can access the more information on climate metrics in the SSE training tool on this topic. We'll share the link in the chat, and you can also find it on the SSE website. Likewise, there are some additional disclosures compared to TCFD for targets as well. For example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. IFRS S2 also requires disclosures of more detailed information on greenhouse gas emission targets, including additional information about any planned use of carbon credits to achieve companies' net greenhouse gas emission targets. And IFRS S2 also includes additional requirements to disclose information about approach to setting and reviewing each target and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. All right, let's talk about some greenhouse gas emissions metrics. And the questions on greenhouse gas emissions often come up in the questions on metrics and targets. So we want to address some of these briefly here. For those who might not be familiar with the different scopes, let's then go through the meaning of scope 1, 2, and 3. Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as electricity you purchase. And scope 3 is then all other indirect emissions that occur in the company's value chain. And then S2 requires a company to disclose its absolute gross scope 1, 2, and 3 greenhouse gas emissions in accordance with the Greenhouse Gas Protocol corporate standards, unless a jurisdiction requires a company to use a different approach of measurement. If a company is using a different measurement method, there is a transition relief to use that method in the first year of applying the standard. Whether and how the company is using an internal price on carbon for decision making, that also has to be disclosed, and whether and how executive remuneration is linked to climate change. And to show it how that works in practice, we have another example. Over to you, Lois.
Yes, this example is from a company called Enel, which is an Italian producer and distributor of electricity and gas. So this example shows one of the ways in which Enel disaggregates, breaks down, and explains its greenhouse gas emissions. And it's just an extract, but at the top of the page, you can see the company's carbon footprint is broken down by scope 1, scope 2, and scope 3 emissions, and we have the total emissions as well. So the pale green bars under each scope tell us the 2021 results, and the darker green bar shows us the 2022 results. So we can see the trend over time. We can see how the scope 1, 2, and 3 figures differ, and we can see the trend between different years. At the bottom of the page, you can see that there's a further breakdown of scope 1 greenhouse gas emissions between business lines. So the generation, trading, networks, end customers, and other business lines. So from this, you can immediately see that the majority of scope 1 emissions come from generation from thermal sources, from the combustion of fuels in generation activities. And again, you can see the trend over 2021 and 2022 by the pale green and dark green bars. There's some little numbers on the extract at the bottom here, and those numbers refer to notes in the accompanying narrative, which we haven't shown you here, but is available in the report. And note 1, for example, shows you that the majority of the emissions from generation from thermal sources were from carbon dioxide, but also some emissions from methane and other gases. The little dots, coloured dots, tell us whether and to what extent the greenhouse gas emission source is considered within a science-based target. So this little diagram tells you so much about the amount of emissions, the type of emissions, the type of gas that caused the emissions, the source of the emissions, the trend over 2 years, and whether any of the emission sources are considered within science-based targets. So let's have a look at a poll now. This is our 7th Zoom poll, so hope we're all ready for another poll here. And this question is, what is the objective of the requirements in the standards on metrics? Is it to enable users to understand performance in relation to the company's sustainability-related risks and opportunities, to understand progress against any targets, or to understand the company's assumptions for the future? And you can answer all that apply. Give you a chance to think about this one. Let's, yes, got good participation there. So let's end the poll now and share the results. So most of you answered that the first two represent the objectives of the metrics requirement. And you are right. The first two answers are right. Now, of course, the metrics might also help users of information to understand the company's assumptions for the future. So there is also truth in the third answer. But the reason that we have structured the question in this way is to encourage you to read the standards themselves, because at the start of each of the disclosure requirements, the standard sets out the objective of each of the disclosure requirements. And in the case of metrics, the objective is in the first 2 points that we see here. So it's not to say that the information couldn't help readers understand the company's assumptions for the future, but the standard says that the objective of the metrics requirements is the first 2. So always worth having a look at the standard to understand the objectives of requirements. It just helps to focus disclosures a little bit more. So thanks, well done. You got that right. Thank you for your answers. Let's go on now to look at the last part of this Align module. And this is about integrating other disclosure requirements that companies might need to comply with. So we know that the ISSB sets a global baseline of requirements, but what do you do if you have to or want to make disclosures beyond what the ISSB talks about? So this goes back to a point we made earlier. You might want to or have to build on the baseline with information beyond what the ISSB standards ask for. And this is because you might have requirements under listing rules or local requirements for both listed and non-listed companies, jurisdiction-specific requirements from your local regulators. And bear in mind that companies in your supply chain might need to be providing you with information to prepare the necessary information that you need. You might need to build on the global baseline to provide additional information to satisfy policy objectives aimed at promoting sustainability. So governments may offer incentives like tax cuts or subsidies for sustainable practices, or they may be giving disincentives for activities that counter national objectives. Companies may also want to or need to provide additional information that aligns with emerging industry practices to show how they're managing sustainability-related risks and opportunities depending on their sector and the sector pathways relating to the transition. And there may be information the company wants to provide to help their stakeholders other than investors, to understand their sustainable strategy, risks, opportunities, and practices. So when we're talking about the global baseline, as we said earlier, the ISSB is working with jurisdictions around the world towards the adoption or other use of ISSB standards. And some countries are doing that by launching public consultations to see what might be involved in their jurisdiction if they were voluntarily or mandatorily to adopt the ISSB standards. More than 20 jurisdictions have already decided to use or are taking steps to introducing ISSB standards into their legal or regulatory frameworks, and those jurisdictions account for around 55% of global GDP. And the ISSB gives jurisdictions that are contemplating or advancing adoption of the ISSB standards specific support through their, or as part of the IFRS Foundation's regulatory implementation program that we've provided a link to in the chat. So you can see details of completed and ongoing jurisdictions consultations around the world in the link we provided you in the slide. Of course, as there are many not-for-profit and mission-based organizations that issue standards and frameworks to support sustainability disclosure, and we've already talked about some of them. CDP, for example, has aligned its climate standard with the ISSB's climate standard. The Greenhouse Gas Protocol is the protocol that must be used for measuring greenhouse gas emissions according to the ISSB standards. So the ISSB is actively involved in the governance arrangements and updates to the Greenhouse Gas Protocol corporate standard. So there's consistency between the measurement method and the disclosure requirements the ISSB sets. The GRI, as we said earlier, is seeking to deliver full interoperability with ISSB standards to the extent possible by identifying and aligning common disclosures so that we have a more seamless sustainability reporting system. We've already talked about the Transition Plan Task Force and the fact that the IFRS Foundation has assumed responsibility for disclosure-specific aspects of its work. And some of you might be familiar with the Task Force on Nature-Related Financial Disclosures. So it issued its own work, and in its work plan, the ISSB is considering how to build upon those recommendations to meet investors' information needs for nature-related information. I won't go through this slide in detail, but if you are a GRI reporter, you might be interested to look at the document that we've given you a thumbnail of on the left-hand side, which sets out how the GRI and ISSB standards are interoperable on greenhouse gas emissions. It provides an analysis and a mapping to show how the two sets of standards are very similar, but also where there are slight differences. As I just said, there's a collaboration, again, that intends to deliver full interoperability on nature-related biodiversity disclosure requirements, and the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. So the two organizations working closely together to ensure a seamless reporting system. I'm sure many of you know that in Europe, the corporate sustainability reporting directive requires companies within scope of that law to make sustainability disclosures, and the disclosures must be made according to European Sustainability Reporting Standards, or ESRSs. So what this slide shows is that the European standard setters and the IFRS Foundation are working closely to maximize the degree of alignment between their work. And in particular, they've already concluded, in particular guidance on climate change that you have a link to in the slide, that there's a high degree of alignment on their climate-related disclosures. And the two organizations are working closely together on alignment as the development of standards progresses. Now, many of you, I know most of you, I think, that responded to the Zoom poll earlier were using integrated reporting. So what you see on the screen here, this thumbnail, is a transition to integrated reporting guide to getting started. So this document shows how the integrated reporting framework can be used as a complementary tool when you are preparing disclosures under IFRS S1 and S2. So when these two things are used together, companies can provide a more holistic view of their value creation process and provide a more complete picture of how value is created over time to meet investor needs for information about value creation. So within this document, there are tools to support integrated reporting and ISSB preparers, including dedicated frequently asked questions, a mapping tool, and this guide to getting started on integrated reporting. Final thing to say about this, I think many of you will be aware of, is that perhaps one of the most important things about integrated reporting is it's underpinned by integrated thinking that can support both disclosure, but also the quality of a company's thinking and corporate governance. So let's go on to look at another Zoom poll now. And the Zoom poll asks, my disclosure objectives should consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance. You can only pick one of these answers. Yes, there's a very clear pattern emerging here. So I'll end the poll and share the results. Yes, of course, you're right. When preparing the disclosures and your disclosure objectives, you can consider all of the ISSB standards, regulatory requirements, and other sources of guidance, including the ones we've just talked about, and integrated reporting is just one of them. So well done, easily got all that question right. So I'm going to hand over to Fiona, who will summarise Module 2 for us.
Great, thank you, Lois. And as Lois said, that brings us to the end of Module 2. So we are 2 ways through our modules, but more than halfway through the content, you'll be pleased to know, because those were our larger modules. So we've covered a lot of the core content there that's really important to get across. But yeah, just to recap, we wanted to run through a brief summary of what we have talked about in this module. So we reviewed the 4 core content areas of the ISSB. So that's governance, strategy, risk management, and metrics and targets. But it's important to remember that these don't operate in silos. We saw in our examples that despite us having those 4 separate categories of disclosure, in practice, that information is all connected. We also discussed how your disclosure might go beyond the requirements of S1 and S2. For example, you might look to meet the needs of different stakeholders, considering regulatory requirements in certain jurisdictions, or also to meet industry standards. And what's important to remember when you're doing this is that the ISSB standards have been purposely developed to act as a baseline, and the building blocks approach therefore allows you to add additional disclosures on top. But in doing so, it is also important to remember that you need to be careful not to obscure the requirements of S1 and S2 in your reporting as you do so. Okay, so as we're at the end of a module, you might be able to guess what that means, which is another Menti exercise. So this next Menti will be focused on looking at the tools that you can use to identify gaps in your current disclosures. So here we are thinking about conducting a gap analysis, so determining how your organization needs to align. And this can be thinking about a checklist of where you're at against the standards, and what the enhancements you might need to make to your reporting are. So what we want to think about here is what tools and resources do you think would be most important to use to help you in that gap analysis? And Lois has shared with you there the link to the Menti. So please do navigate into Menti again to have a look at this, and I will share the screen just so we can see the results coming in. So we have some responses in already, which is great to see. So I'll just have a look at that whilst the rest of you are having a little moment to think about your responses. So the first responders shared that we could look at a combination of disclosure frameworks, gap analysis tools, sustainability reporting software, and third-party assurance to provide a view of areas needed for improvement. Also benchmarking and internal audits, apologies. So that's a really comprehensive response already, I think, that gives a flavour of exactly some of those different resources and tools that you could draw upon to support you in this space. As you say, I think using software is great if you have that option to help you sort of set up a structured way to collect this data, and getting that third-party review and assurance, I think hopefully the accountants will agree, is always a really good way to be able to test the robustness and readiness that you might have for reporting. And of course, if you're at the stage where you haven't necessarily reported publicly yet, which I know is the case for many of you, you could get that assurance provider to look at doing sort of a readiness assessment for you to provide you with initial findings and recommendations before you actually start reporting publicly. So I will give the rest of you a moment just to think. So please do share any ideas that you have, any resources that you might want to draw upon. I also see benchmarking has been highlighted again, which is, of course, really important. So I think, you know, as much as you can, trying to think about either companies regionally that might be relevant, perhaps within other markets, but still, you know, within your region can be helpful to get a sense of what they're doing. And also thinking about benchmarking against other companies globally in your sector as well. So there can be some good resources out there to support with this. Lois already mentioned the work of the WBCSD, the World Business Council for Sustainable Development, on preparer forums. So those forums often bring together lots of different examples of reporting. So that could be a good source to look at for benchmarking. We have software mentioned again, and internal audit as well, which is also a good call. So yeah, perhaps before you go straight out to external providers, maybe getting your internal audit teams to look as well. Also engaging consultants to assess and review. Yes, the objective approaches from a consultancy who might be working with other organizations on this as well can be really helpful to get that outside view on what they would recommend. Several of the mentions of gap analyses and benchmarking, and internal audit again. That's brilliant. Lots of benchmarking, consulting, providing guidance. Yep, exactly. Gap analysis templates. Yes, exactly. We talked about the SSE's sustainable finance reporting checklist, which you could use potentially as a template to help you there. And we've shared the link to that already, but it'll be in our slide materials too. Conducting a combined assurance might also help. Perhaps we're talking there about looking at assurance across both finance and sustainability at the same time, I think, which I think, again, could be very helpful, because if you're starting out with sustainability reporting, I think looking at the maturity and preparedness of your financial reporting processes and how they could be adapted would be really helpful. Great, we see lots of new responses coming through now as well. So we also have looking at risk assessment tools that help to evaluate potential risks and identify areas where maybe disclosures aren't sufficient. Definitely. So if you have any existing enterprise risk management process tools that you could use to support you with that, that's often a great starting point to work with your risk teams on. You might also look at particular tools out there to help with certain sustainability risks. So, for example, if you search publicly on climate risk, there are lots of different tools that you can put your information into to help you getting a sense of different types of risk. So looking at competitors, looking at disclosure frameworks, yes, exactly. So as we've talked about with that building blocks approach, the voluntary frameworks provide a lot of supplementary guidance on particular topic areas or industries that will help you to report against the standards and provide some of that detail. That's great. And quality assessment. Yeah, so thinking about data quality and making sure that you've got that eye to preparing information with a focus on consistency, comparability, etc., as we've already talked about, is really important as well. Lovely. So I think we'll pause on the assessment there, but thank you again for lots of great ideas on that. But I'll leave that open for a little bit longer in case anyone wants to share in the background before we head back into the presentation. Great, so I'm handing back over to Lois now, I believe, for our next segment.
Thanks, Fiona. Yes, so we're moving into module 3 now, about effective disclosure processes and practices. So module 3 is called Implement, and it's more about how you do certain things. You may have noticed that everything we've discussed so far has really focused on what a company should report, what it should disclose. So now we're moving on to look in a bit more detail, practically at how it's done, starting with the practices and processes needed to collect data and make decisions. So there's 3 modules to this. We're going to start with identify, and in particular, we're looking at how to identify sustainability related risks and opportunities. So the standard tells you that your sustainability risks and opportunities should be disclosed, but how do you go about identifying them? So IFRS S1 asks companies to provide material information on all sustainability risks and opportunities that could reasonably be expected to affect its prospects. And IFRS S2 sets out the requirement for climate-related risks and opportunities. But what about where you have risks beyond climate, other than climate, say on biodiversity or water or human rights? There are no ISSB standards on those subjects at the moment, so what should you do? Well, the standard says that to identify other types of risks and opportunities, a company should take into account the ISSB standards. So note the words it shall consider. So a company must consider the ISSB standards when identifying which risks and opportunities to disclose. And as we know, the ISSB standards are based on different sectors. So they tell you what the likely industry-based risks and opportunities are. In addition, a company may consider the CDSB framework application guidance. All of these types of documents are available from the IFRS website, and the CDSB application guidance has guidance on water and social matters, climate and biodiversity and nature. Companies may consider their industry practices, so perhaps you belong to an industry body that has developed guidance to help identify the risks and opportunities applicable to your industry. And companies can also use the materials of investor-focused standard setters, and we saw the logos of many of those on the slide earlier. So when you've identified the risks and opportunities, what type of information should you disclose about them? Again, the ISSB standard says that for matters other than climate, where S2 applies, companies shall consider the ISSB standards for disclosure topics on particular risks and opportunities that apply to their industry. The company can also consider, to the extent that it meets investor needs, the CDSB framework application guidance, industry practice, materials of investor-focused standard setters as before, but the companies can also look at the GRI standards and European sustainability reporting standards for determining what type of information they should disclose on sustainability-related risks and opportunities. Let's have a look at an example now about how a company called Yara in its 2022 annual report identified risks and opportunities. And Yara is an international global crop nutrition company. Let's start at the top, and we'll see that the company has started by looking at global macro trends that inform Yara's market megatrends. So they're taking the big picture. Fiona was talking earlier in the presentation about the World Economic Forum's annual risk report. So that could be a good source of understanding global macro trends. And you can see these global trends are things like growing and increasing urban global populations, geopolitical and trade uncertainties. So they apply at the global or mega level, the macro level. At the further towards the bottom of the slide, what the company's done is they've translated the way in which those global trends apply to their own company. So what opportunities and risks emerge from those global trends for the company Yara. So on the risks side, we see that they identify regulatory changes as risks, consumer demand for sustainable products, and the fact that optimized fertilizer use might lead to lower fertilizer demand growth. So they make fertilizers and they see demand for sustainability might give rise to the risk that there's lower fertilizer demand and lower fertilizer growth. They also identify as risks environmental costs and taxes that can increase their overall costs. And of course, for a global crop nutrition company, physical climate risks to their operations and customers are very pertinent. On the opportunities side, they see that there's an opportunity to use digital tools to enable new market channels, to reduce yield gaps, and to increase farmer connectivity. So these types of digital tools include things like drones and mobile connections can help farmers connect with each other and understand through observation how yields are doing. They say that opportunities also come from a greater focus on soil health, water use, and biodiversity, where they can use optimal fertilizer use to have a positive impact. So just an example of what Yara's done to identify risks and opportunities in sustainability. I'm going to look at a slightly different example now. This is from a company called Nest and their 2023 annual report. So Nest is a company based in Finland, and it's a producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. So to some extent, it's dealing with sustainable products. It's using science and technology to transform waste and other resources into renewable fuels and circular raw materials. So in this extract, we're seeing that the company is telling us the potential implications of different risks and opportunities for the company in 3 different temperature scenarios. So that in the net zero world scenario, that's broadly equivalent to a temperature scenario of 1.5 degrees. The middle one is a 2-degree scenario, and then at the end, the compromised climate scenario relates to a 2.5 to 3-degree temperature outcome. And the risks and opportunities are considered in these 3 different scenarios over a time horizon until 2050. So the extract shows an overall assessment of whether each scenario is positive or otherwise for the company and the indicative financial effect. So you can see that the most positive financial effect is for this company is assessed to be in the net zero world, and perhaps that's to be expected because their business model is focused on development of renewable fuels and circular products. So a slightly different way of assessing and identifying risks and opportunities from Nest. Now, as we said earlier, so I won't go into this in detail, The ISSB recognises that the identification of risks and opportunities, collecting data that enables disclosures about them, it can be complicated, especially when companies are first setting out and maybe have not had a chance to develop processes to help. So it can be a challenging exercise. It's also very valuable, of course, to determine what are your risks and opportunities and to make disclosures about them. But to recognise the challenges, the ISSB says that in applying these specific requirements on risk and opportunity identification, a company is required to use all reasonable and supportable information to it at the reporting date without undue cost and effort. And we talked about that a bit earlier, but what do we mean by reasonable and supportable information? Well, it's information that's specific to the company. So we saw that with Yara, didn't we? They sort of translated the global risks and opportunities into specific ones for their company. It takes account of the external environment, as we saw with the Yara example. It includes information about past events the company will know about, current conditions again, but also forecasts, perhaps informed by scenarios, as we saw with the nest example. In some cases, what you have to take account of is specified by the IFRS sustainability disclosure standards themselves, but as we said earlier, there are some requirements where the standards say that a company can use an approach that is commensurate with its current skills, capabilities, and resources. So Fiona is going to take us through the next part of the Implement module.
Sorry, thank you, Lois. That's great. So moving then along, we have obviously looked there at identifying risks and opportunities, but the next step is to evaluate the financial effect of those risks and opportunities. And this can often be the most daunting element when first starting. So we'll cover here a few brief concepts that help with this process. And I know a few of the questions we've had in the chat and Q&A relate to quantification as well. So hopefully this will give you an idea of some of the concepts that you could look to support you in this area. So to help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. And it also asks for the company's financial and operational capacity to adjust or adapt to those issues over the short, medium, and long term. So, for example, you might test your company's resilience against a new regulation to limit certain high emission activities, or your company's ability to respond to changing crop yields due to more frequent heat waves. So to do this, you'll need to use scenarios that are based on science and analyze how those scenarios will lead to your company incurring the effects. So it's important to remember that scenario analysis doesn't require you to predict the future. It's a tool to test your resilience against potential future effects. So it's about sort of plausible potential pathways, not necessarily about predicting or forecasting the particular likelihood of a certain thing happening. And S2 doesn't specify which scenarios a company shall use in its analysis, as it leaves that down to the company to determine. But it requires that the company uses relevant scenarios and provides information about which it has selected, and that it provides information about other relevant assumptions that it has used for scenario analysis. S2 includes guidance on how a company can determine its approach to scenario analysis. So this encompasses a range of practice from qualitative scenario narratives to complex statistical modeling. And indeed, as I know that not many organizations here have responded to the TCFD before, which would have got some organizations thinking already about scenario analysis, it's understandable, of course, that you would initially be starting on the more quantitative side of this activity and perhaps progressing to more qualitative side initially and progressing towards more quantitative analysis in time, or in particular with a focus on any areas that you think may be material for your organization and wish to assess further. So again, ISSB here ask organizations to use an approach that is commensurate with their circumstances, and that they use all reasonable and supportable information that's available without undue cost or effort. So, there's a proportionality to this exercise based on your capabilities and indeed the particular level of risk exposure you might expect to have. So again, we'll look at a couple of examples here to help you with this. So the example we're going to be looking at is Cemex, which is a Mexican buildings and cement company that's active in a lot of countries globally. So Cemex have used scenario analysis and provided a disclosure on this within their integrated report, which shows how it combines this analysis with the different potential development scenarios. So the table here describes the risks on the top left, and the opportunities below that. And then what they have done is mapped those risks and opportunities against different scenarios. And I think the scenarios that they have drawn from here are the International Energy Agency, or IEA scenarios. So you can see that under these different scenarios, they may expect the risks and opportunities to play out differently. And I think what's interesting as well to see is that overall, actually, they're suggesting that some of their opportunities will be quite significant for them, particularly relating to enhancing their reputation, embracing new technologies, and driving energy efficiency. So that's quite interesting as a conclusion from their initial analysis. And alongside this summary table, which shows the scenarios, they also provide information about the particular assumptions that underlie each scenarios on a further page in the report as well. So they have that detail in the disclosure too. So when we're anticipating the materiality of these future events, of course, that can be very challenging. And so to help with this determination, IFRS S1 asks you to consider a number of issues to help you with your determination. So you could think of this list as identifying all the steps and information that you need to come to this judgment. So for example, you should be considering low probability and high impact outcomes. For example, a company should also be looking at the uncertainty related to the company's future cash flows. And another important point here is the need to reassess this at each reporting period. So it's important to keep these variables under constant review at each reporting period, so you can make sure that you have adequately reported on what those potential uncertainties are. Great, so with that, I'll hand us back over to Lois again.
Thank you, Fiona. And we're on the last section of our implement module now. So the third concept we wanted to discuss in this unit is about integration. As you may remember from the Align unit, disclosures shall include a description of whether and how climate or sustainability related risk management processes are integrated into the company's overall risk management process. So although the standards are new, it may be that you have processes and data flows that you can use to apply to the standards already. So we're going to look at whether and how that might be the case. So many of you have talked in the mentees and so on about gap analysis and so on. So this is one way in which a company can assess whether its existing systems and processes are sufficient for sustainability related financial disclosure or need to be developed, or actually whether even new processes need to be developed. But, as I said, we think you'll have some processes already for collecting the type of content described in Module 2. So what should management consider when determining whether those processes are sufficient, and hopefully they don't need to start from scratch developing something new? We've talked about the gap analysis already, and I think you can see that you are already well aware of how helpful that can be. But also think about how suitable existing processes are for identifying sustainability related risks and opportunities. We know that they are often a lot more uncertain as to how those risks will manifest, how, when and where. So it may be that different criteria are needed for the assessment process. For example, criteria that include the likelihood of the risk, its impact, vulnerability of the company, and the speed of the risk's onset. What about internal controls? Many companies have internal controls processes. They will need to be evaluated to see if they can support the sustainability disclosure that companies are due to do. Then what contributors do you need from your organization to help with the disclosure? Which departments will be involved? Who's got relevant processes and expertise that they can contribute? Some of you mentioned in the Menti having team meetings or meetings across the organization to determine who has this expertise, the process and the knowledge. What are the interconnections between different internal and external factors that affect sustainability disclosure? We've seen this in some of the examples already. What uncertainties are associated with sustainability-related risks and opportunities and disclosures, and how is management going to deal with those uncertainties? And finally, what resources are already in place to manage sustainability-related risks and opportunities and disclosure, or what new systems and processes might be needed? Perhaps you need to go through a change management request process within the organisation. And you've got a link there to a World Business Council document that sets out some of the considerations that apply here. Now, we've mentioned before that you have some homework, and the homework is about developing a disclosure plan. So why would one develop a disclosure plan? Well, a disclosure plan can be a standalone strategy or part of a wider disclosure strategy, for perhaps including your governance and finance disclosures as well. But what it enables a company to do is to think about and record the approach to certain questions, such as what are the company's reporting goals and objectives? What types of standards do you have to or want to comply with? To what extent is the disclosure really designed to communicate management strategies as well as to comply with standards and laws? How are those different goals and requirements of standards and management's communication strategies to be managed in terms of presentation and information collection? Which audiences does the company want to communicate with? Just investors or wider stakeholders, customers and others? Who will be involved in developing the disclosures? The risk management team, probably, finance, procurement, company secretarial, operations, could be a range of people and departments involved. How are they all going to be organised, and what will their responsibilities and timelines be? How will you get the data? Are there existing systems, controls and processes that can be used? And what about data quality? Will the disclosures be assured internally or externally, and to what extent? And importantly, what will be the sign-off procedures? So a disclosure plan helps you to address all of these questions and to take control of your narrative about your company's strategy, your company's risks and opportunities. It can support the internal collaboration, knowledge sharing and teamwork we've talked about, and also, and I think most importantly, act as a reference point and audit trail to record where and how judgments have been made, so that when you start each reporting year, you can look at this disclosure plan and know how things have been organised in the past at least. So we're going to look at an example. It's an old example from 2022, and there are many more examples emerging of how companies set out how they have prepared their disclosures. So this example from Hammerson, which is a British property developer, illustrates the basis on which the company is reporting, so how they've done They're reporting on environmental and social impacts. They tell us the period to which the report relates. They tell us the scope for data collection and verification of the ESG performance data that they've put in their annual report. There's a number of things that they tell us here, including the reporting scope, so which of the group entities that are included in the report. But agreeing this before getting started is really useful, so that you don't have any surprises or a lot of work to do at the end of the reporting year, but also so that you're able, as Hammerson has done, to set out exactly how they prepared their disclosures, including what types of standards they're using and where they actually summarize the information that they're giving. So let's move to another Zoom poll now, which is designed to help us think about the disclosure plan in a bit more detail. You can only give one answer, single choice, and the question is a disclosure plan required by the IFRS Sustainability Disclosure Standards? You can answer yes, you must disclose your plan, or no, but it's a very helpful tool. Give you a moment to think about this. Lovely. We're nearly at 50% participation now, which is great to see. So thank you, all of you who are filling this in. Now that we're at 50% participation, I'm going to end the poll and share the results. 59% of you said yes, and you must disclose your disclosure plan. And 41% said no, but it's a very helpful tool. Those of you that said no are correct. There is nothing in the IFRS Sustainability Disclosure Standards that says you must have a disclosure plan and you must disclose it. There are some parts of the standards that say things like you must tell us what methodology you used for some of your measurements or what risk management approach you used. Yes, there are some things that must be disclosed about particular approaches and methodologies. But overall, there is no requirement to have a disclosure plan. But as you have rightly identified, it's a very helpful tool, and that's why we have recommended it for your homework. But there's no obligation to do it. So if we go to the next poll now, we'll go through the next poll quickly. Here we are. What can a disclosure plan help us to do? Select all that apply. Can help us to take control of the narrative within general purpose financial reports, support collaboration, knowledge sharing, and cross-functional team discussions. I hope the Zoom poll has been launched because I can't see it on my screen. And it acts as a reference point, an audit trail for disclosure preparation, or it is a reason to skip full disclosure. Just reaching out to my colleague Fiona to say I don't actually see the Zoom.
Yeah, I'm not sure why, Lois. I have it up here, so I'm happy to read the results out if you like.
Oh, thank you so much. Thank you.
No problem. We could just give everyone a little second more to go. We've got about 33% in. Okay, I'll close off there at 40%. So just to give you the results, Lois, so we have most people answering the top 3 answers. So I'll hand back to you just to reveal the correct ones.
Yes, they are all correct, of course. The first 3 apply, and of course, a disclosure plan is not an excuse to skip full disclosure as prescribed by the ISSB. So yes, everybody got that question right. So well done. And Fiona, over to you for the Module 3 summary, please.
Lovely. Thank you, Lois. Great. So as Lois says, that brings us to the end of our third of 4 modules. So well done, everyone. We're doing a good job making our way through the content. So the next part I'm just going to do is briefly summarize what we've covered. So connections, of course, is something we've really landed on in this section. So here we kind of highlighted the importance of connections, firstly between the 4 core content areas. And then we learned in this module that there are many connections as well between a company and its external and internal environment. And so really understanding and assessing these connections is key to considering those risks and opportunities. We then talked as well around evaluating risks and opportunities, keeping a track of those assumptions that you use, and starting to employ the scenario analysis tool. And then finally, we talked a bit about data. So making sure that if you are already disclosing, that you're collecting and making good use of what you have already got in place. But also if you're starting from scratch with this or starting at the early points, that you are kind of getting the right things in place at outset to help you. So we have a Menti exercise here. I'm going to move through it fairly quickly, just in the interest of time. But some of you I see have already navigated to Menti again. And so our question for you now is going to be around looking at what existing systems and processes for data collection you could adapt to support you in your reporting. So we'll just spend a short minute or two on this question. So we'll just give it a second to see if anyone has any thoughts here around how you could adapt existing processes to support sustainability data collection, whether you have any particular systems, tools, processes that you're using for data collection that you think would be most important here. So I'll give you a minute or two. So I know it's quite quick to have to think about this one, but I'll just wait and see if we get a couple of quick responses in, or I can share a few suggestions as well. Okay. No thoughts anyone wants to share? A few things that I guess we would recommend whilst you're having a little think would be around, of course, your enterprise risk management process. So in particularly, the assessment of risks here is really important to draw from that ERM process. So definitely adapting that, but some things that you may need to change within your enterprise risk process would be ensuring that you have the right risk types within the system to enable you to assess sustainability risks and impacts. And then also thinking about the time horizons as well. So do you perhaps need to extend the time horizons of your risk process to support you better in looking at sustainability issues over the longer term? You might also think about your existing software that you use for financial or other operational reporting and data collection, and whether perhaps that reporting software could be adapted to support sustainability information, or perhaps indeed you're already collecting data that can be used for sustainability reporting within that. Thanks as well for the responses we have coming in. So we have around conducting interviews. Yeah, so that might just help you to understand what those processes you have are. Maybe using surveys and questionnaires, looking at your reporting from government bodies as well. Yeah, so exactly, that might give you some information that you could use to support you, and doing questionnaires. So thanks for sharing those thoughts. We'll leave it there, but I'll leave that open in the background as well in case anyone has anything else they'd like to add into it. And otherwise, I'll hand over to Robert now, who will be moving us into the next segment.
It was nice. Sorry, John. Thank you very much. Yes, indeed. We're now moving to the final module of this workshop, and we're dealing with the communication, and there'll be then dealing with some more practical questions on when and where of the disclosure sustainability related financial informations. So with that, we'll be then having 3 sections in this module: location and timing, efficiency, and confidence. Then let us go through that. So the first one, to get us started, we'll look at the location. In this section, we are looking to clarify where sustainability disclosure should be located. But before we answer this question, I want to briefly go back to the relationship between the investor-focused disclosure requirements and the multi-stakeholder focused disclosure requirements from GRI. So on one hand, we'll have the IFRS produced investor-focused financial accounting and sustainability-related financial reporting disclosure requirements. And this, on the other hand, we're going to have the GRI ones. And this holistic package supports this, you can call it dual purpose reporting model, where IFRS and FASB standards address investor needs, while GRI standards expand on sustainability metrics relevant to broader societal concerns. And investor already have access to companies' financial statements, and ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. And these all come together in a reporting package that we call a general purpose financial report. And the requirements in ISSB standards about what information to report are based on existing sustainability reporting regimes focused on investor information needs and on aspects of financial accounting standards. ISSB and GRI reporting standards share some content requirements, for example, what to report, but the ISSB standards are focused only on investors' information needs and decision-making, reflecting the mission of IFRS Foundation to bring transparency, accountability, and efficiency to capital markets around the world. Both organizations take different approach to define materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, where the IFRS approach is familiar to accountants and relies heavily on management judgment, aligning with existing corporate risk management processes. And a simple example is where double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. So there is an interrelationship and overlap between the two as well. All right, and now we'll be coming back a little bit more to the definition of the material information in the context of the sustainability disclosures. As we just noted, materiality has different definitions for different reporting standards and audiences. So let's briefly recap what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. Once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. This is where our materiality definition comes into play. The definition of material information used in S1 is based on and aligned with definition found in IFRS accounting standards. It is the information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investor decisions. In other words, the ISSB standards seek to identify disclosure of key information that matters to investors. And yes, and then continuing with that, investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. This means that a company does not need to disclose information that is not material, even if the ISSB standards include it as a specific requirement. And there are key elements to remember here. And the first one, it's to ensure that material information is clearly identifiable and that you use a plain language. It's also important not to scatter it across disclosures, and to finally include any additional non-material disclosures if required by regulators, but ensure it is clearly identified as such. And to help you to understand this topic, we'll go to the next Zoom poll. So the question is, information should be disclosed in the annual report when applying ISB standards if, and three options possible, and you can select any which that apply. First, A, omitting that information could reasonably be expected to influence investor decisions. B, it could reasonably be expected to affect the company's cash flows. C, it exemplifies the values of the leadership team. So let's see how you're answering. I will see the, thank you very much for taking part in this one. Let's wait a moment to collect a few more responses, and looking good indeed. All right, I'll then close the poll and we'll discuss the results. Right. Yes, indeed, most of you answered correctly. So the disclosed information, or should be disclosed, the information should be disclosed when omitting the information could reasonably be expected to influence investor decisions, and that it can expect it to affect the company's cash flow. So A and B are the correct ones. It's not about the leadership team, so the answer C is incorrect. So all of you who answered A and B are right. All right. And so we're now moving to the question about where the ISB standard should be reported. Disclosure under the ISB standard has to accompany the financial statements and be part of the same general purpose financial reporting package. But as one does not say where in that reporting package the information should be provided, this is designed to allow jurisdiction-specific requirements on the location of the reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as a part of the same reporting package as the company's financial statements. Also, sustainability disclosures must be provided at the same time as the related financial statements, cover the same reporting period as the financial statements, and be authorized by the same body or individual authorizing the financial statements. What we saw from the practice, which was been reported by the WBCSD on the state of the integrated reporting, shows that nearly 2/3 of companies continue to put sustainability information in standalone reports. This is not what ISB standards require, and because that's ISB standards required financial disclosures, sustainability-related financial disclosures to be included with the general purpose financial reports. So there's a clearly room for improvement, and this suggests many companies have some way to go to get their internal process and disclosures plans aligned. All right, we have now an example of that. Over to you, Lois.
Thank you, Robert. And this example is from a company called Ayala from their integrated report, and it is a conglomerate. They have lots of different businesses in property development, banks, healthcare, technology, and so on. So some of you might be familiar with this sort of presentation because it's an integrated report. And what the company is doing here is they're organizing their information by showing what types of capitals need to flow into the value creation process: financial, intellectual, human, social, and relationship capital, and what value is generated from the value creation process in the very final part of the screen there. So this is the arrows that you see on the screen here tell us where information can be found about all of the different elements of the company's value creation process and all the different types of information about it. So strategy on page 50, business model, page 54. And you can see that what they're summarizing in this one diagram is information about their risks and opportunities, strategy, finances, outlook. So in one page, what we see is a comprehensive picture of how the business creates value in a very summarized format, but also references to where in the report we can find information about each of those particular important elements of the value creation process and what it means in terms of disclosure. So of course, this example and the others we've looked at, they're extracts taken from PDF documents. But of course, digital reporting is evolving fast, and Robert's going to tell us more about that next.
Yes, great. Thank you very much, Lois. Indeed, there's a big role of the technology which plays in financial reporting and also in the sustainability reporting, and it's an emerging consideration for disclosures. So increasingly, corporate reporting is moving away from PDF reports towards information on web pages and structured data sets, such as those databases offered by stock exchanges. And the IFRS Foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards. So the taxonomy does not introduce any new requirements. So a digital taxonomy provides the common elements or tags needed to make your sustainability disclosures machine readable. This makes it easier to take large data sets like information from entire industry and bring them all together to analyze them. So consequently, digital reporting has a number of benefits. It makes the reported information easier to use for analysis. So data is structured in the same way across businesses in a machine readable format. Tagging information potentially allows for automated checks for quality and consistency. And more data collection management systems are now compatible with digital reporting taxonomies that improves the processing and report preparation. Tags have labels and descriptions in multiple languages. So if your report of your quantitative data is in one language, someone speaking another language can also understand what it means. All right, so we'll be moving to the next section about efficiency and how to communicate efficiently and effectively. Following the discussion on location and timing, let's now think about ensuring efficient disclosures. We added this to the training because a common comment we find from companies is that there is a growing reporting burden. What we hope to highlight is that when done correctly, efficiencies can be made to reduce that burden. So first of all, it's important to understand what effective communication looks like and what is required. Often companies think that if they just put all the information they have into the report, then everyone will be satisfied. However, this would be against the core concepts in particular fair presentation. For example, it could be helpful to ask these questions. Is this information clear and concise? And what we mean by clear is that the fact that information is clear might depend on the nature of the information. For example, whether it could be clear to present information in tables, graphs, diagrams, plus with associated text. And the matter of being concise, and to be concise, the disclosures need to avoid or should avoid boilerplate information, unnecessary duplication of information, and to use clear language. And to ensure quality of information, some preparers watching today might be thinking to themselves that they still don't see what is it all fast about. And perhaps their experience focuses on standalone sustainability reports, or they haven't had much interaction with external audit. So to the accountants watching, I would say be kind to your colleagues. Help them understand the difference in rigor that's required in data collection, oversight, sign-off, etc. for financial statements. This means, for example, disclosure include comparative comparative information are to be restated as necessary. Disclosure should avoid unnecessary duplication and use cross-reference as required. Information has to be material, be connected, and aggregated or disaggregated appropriately. And we briefly mentioned cross-referencing. So let's then discuss here a little bit what we mean by that. As you may have already noticed, there may appear to be some overlap in the disclosure topics. For example, you might have the same governance approach for all the sustainability issues. So rather than duplicate certain information, you can use cross-referencing to enhance efficiency of your disclosures. Cross-referencing to the other report is permitted as long as the other report is available on the same terms at the same time as sustainability disclosures. The cross-reference information is assumed to become a part of the same reporting package. And cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. And again, to show it in practice, we'll have an example on that. Over to you, Lois.
Yes, this example is from a company called CRH, and CRH is a manufacturer and supplier of products for the construction industry. It's based in Ireland. Now, we can see a number of things illustrated in this little extract, both connectivity, but also effective disclosure. So what the company's talking about in this extract is the impact of climate change and emissions reductions targets on their financial statements. They're talking about whether the climate change plans and carbon emission reductions targets have been considered when preparing the financial statements. So you can see there's a cross-reference in thinking there between the types of risks and opportunities that they identified for climate change and the way they're looking at their financial statements. So at the start of the paragraph, they tell us using the TCFD recommendations, what are the climate-related risks that they have identified and what GHG reduction efforts are in place. They then tell us that they've considered when preparing the financial statements, whether those risks and the measures they're taking to mitigate the risks have any effect on the financial statements. So they have looked at their impairment testing, the useful lives of assets, their provisions for liabilities, their inventories, and their retirement benefit obligations. And we can see the cross-reference to the relevant pages in the financial statements where we can find those line items. So their emissions reductions targets, their decarbonisation plans have been considered against the line items on those pages. Now, this company concludes that the risks and plans have no material impact on the financial statements. The directors and the governing bodies have made that judgment using the company's accounting policies, estimates and underlying assumptions. So they're existing estimates and assumptions they use for the preparation of the group's consolidated financial statements. So there's nothing they have to say about the financial statements, but what's interesting about this example is it is an example of effective disclosure to tell the reader that they have considered whether there are any effects on the financial statements. They've concluded there aren't any effects, but at least they've told us that they have considered the situation. Now, at the moment, the International Accounting Standards Board has an open consultation on reporting on climate change and other uncertainties in financial statements. And in fact, in one of the examples they give, example 1, it's a bit like this in that they say, even if you're in a high emitting industry like construction, even if there is no effect on your financial statements, it is helpful and effective disclosure to tell your investors that you have at least considered it. So back to you, Robert.
All right. The next slide, we'll be looking at some mechanism that should support your adoption, that offers some flexibility and reliefs, which should make the application of the disclosures easier for many companies. So we have sought to apply a number of mechanisms to support preparers to get started with the ISSB standards. And one simple thing be to put place was to adopt a well-known terminology and concept familiar to preparers, borrowing from the ISSB accounting standards, for example. And many requirements in S1 and S2 are to be applied proportionally, recognizing companies will have a range of capabilities and preparedness on these issues. So, for example, qualitative scenario analysis are permitted. You will see the phrase all reasonable and supportable information at the reporting date without undue cost or effort, or consumer it with skills and capabilities and resources in a number of places. And this is to recognize a different stage of the maturity of the sustainability knowledge and awareness within the companies and the different resources the companies have. And there are some important reliefs as well. And the reliefs for the first year of application have also been introduced and include that companies being able to limit disclosures to climate in year 1 and begin reporting on their sustainability related risks and opportunities in year 2. The other relief allows companies being able to provide annual sustainability related financial disclosures with their next half-year reporting, rather than at the same time as financial statements. And finally, some companies not needing to provide disclosures about scope 3 greenhouse gas emissions apply the greenhouse gas protocol corporate standard to measure emissions if they are already using a different measurement approach, or provide comparative information in the first year of reporting using S1 or S2. Another relief allows companies to include greenhouse gas emissions information obtained from companies in the value chain with a different reporting cycle. As we already mentioned, a number of other sources of guidance and resources, including SASB standards, CDSB framework application guidance, among many others. So these reliefs are designed to enable companies to put in place reporting practices and structures to provide high quality decision useful information. And jurisdictions will decide when to mandate adoption, but the standards are effective from the 1st of January 2024, and we know many companies are now preparing to adopt them voluntarily. To address this, we'll have some questions to help you to get a better understanding and then check whether you had got it right. So information disclosed in accordance with the ISSB standards should be, and we have 4 options here to choose from. A should be decision useful, should be material. C should be misleading. D, comparable. Yes, and we have answers coming in. So I think it should be fairly straightforward on what should be the qualities of information in accordance with the ISSB standards to disclose it. Yes, and you got it right. Of course, the answers are A, B, and D. So it should be decision useful, material, and comparable, and information should not be misleading. So I think there's no dispute about that. With the next example, I'd like to ask you this question about information. Is decision useful if it is A, relevant and faithfully represent what it purports to represent, B, comparable, C, verifiable, D, timely, E, understandable? So thank you very much for answering these questions. And yes, we have a good, let's close the poll and show the results. Indeed, you all, most of you answered correctly. All of the answers are correct. So the information is decision useful if it meets all these 5 qualities listed in the question. So well done. All right. So now moving to the last section within this last unit within this module, we'll talk about the confidence. So finally, in this last section, we'll look at how you can ensure that the users of financial reports have confidence in the data you are disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over greenwashing. An important trust builder is showing data and trends over time. This is why ISSB standards ask for comparatives. And comparative is information comparative information, it provides context which helps to indicate progress and underpins strategy and risk management. Metrics disclosed by a company might be redefined or replaced over time, or the company might change its method of estimating a metric. In this situation, it is important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. Occasionally, it may also happen that a company's sustainability disclosures might contain material errors. In this situation, the company is required to restate these errors in the comparatives provided. Revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or obscured as a result of not revising or restating the comparatives. And information can be qualitative and quantitative. Companies, what is important here to state and note is that companies sometimes express concern with sharing the information that they deem to be sensitive, or that if shared could deplete their competitive advantage. So in this situation, the ISSB standards relieve a company from disclosing information about sustainability-related opportunity if that information is commercially sensitive. If this is a concern you have, there's a further detail you can read in the handout. Finally, it is important to build confidence by providing clear statement of compliance. A company that complies with all requirements in the ISSB standards, even the reliefs, is required to make an explicit statement of compliance. We are publishing further guidance on this topic, and I will paste the link to this document. Is about the voluntary application of ISSB standards, a guide for preparers. You can then have a further read of this document. All right. In the matter of time, I will then hand out right now to Fiona.
Great, thank you, Robert. We are just up against the clock ever so slightly, so apologies if I rattle through our final points just a little briefly. But just to recap on this module, of course, we said be really clear on your audience and think about the right format to communicate with your investors. Start and focus on the material information and be as concise as you can. and ensure you're setting up those right processes to be confident in your data practices. So Robert's given us a really good overview on all of those aspects. So we will just be skipping the final exercise in the interests of time. So no need to, I've skipped past that one in Menti. However, if you go into Menti, I'll just flash it up very briefly. We'd love to know quickly where you're up to against the different objectives that we set ourselves at the start of the session. So feel free to just let us know quickly. Do you feel more comfortable than where you did at the start of the session in each of those areas? It's great for us just to test how effective the training is. Are we helping you to address those areas? And I can see from the respondent who has come back to us so far that they're looking like they're feeling more confident. So that's great to see. But I'll leave that open for you to respond on in the background whilst we just walk through a few final points to wrap up on follow-up for you. So as we've mentioned, there is a homework assignment that you can download online that will help you to keep progressing your thinking in each of these areas. So I recommend going to our website to have a look at that handout if you'd like to have a go at that. And then in terms of resources to support you, all of these links will be available in the slide, but just to mention briefly, we have the IFRS's Knowledge Hub and the guidance of the standards themselves, of course. We have the IFC Beyond the Balance Sheet Disclosure and Transparency Program, which we really recommend looking at as well. And finally, we have the UNSSE's toolkit of resources as well. So you should have received links to lots of these things already, but do check out the handout materials for further links. And then finally, thank you all for sticking with us throughout this training. We know that this is quite a long time to be in a dedicated session, and we really appreciate that focus and attention and your interaction throughout the session. So if you would like to receive the thank you for participating of a participation certificate, we'd like to ask you to please complete the feedback survey, which we'll be sharing the link to shortly with you in the chat. So Lois should be posting that link in a few minutes, or I think it's actually there already. And that will also come through to you via email from Zoom. So if you fill out that feedback survey, you should receive a certificate from us. It normally takes about a week for us to send those to you. So please just be patient slightly whilst we get those out to you, but thanks again. And a final few closing words just to say thank you to all of the SSE supporters who make this program possible. And of course, to the Lesotho Institute for Accountants and the Maseru Securities Market for their kind support to host today's session and to support with your questions on the local context as well. Then, of course, thank you to all of our partners at the IFC, the IFRS Foundation, for all of their expertise that they shared with you today. So a big thank you again from all of us for joining us. I really hope this session has been useful for you, and very best of luck with all of your future reporting. So we hope to see you again soon on a future webinar, but thanks again. We'll leave it there.